Withdrawing their 2026 outlook due to that tariff uncertainty, reiterating the outlook, though, for this year. And Stellantis, of course, as we talk about the auto sector, as we talk about the hit it may take, we're looking at first quarter consolidated shipment estimates actually dropping quite a bit, guys. So the tariff story reflecting on the individual basis.
And we're going to hear from the banks later on today. That's going to be one of the main events on Wall Street. We'll count you down to that a little bit later. We're counting you down to the market open right now here in Europe. The opening trade is upon us. Let's take a look at the numbers that we're giving you right now. The FTSE is a little higher. We're expecting circa 0.5%, maybe out of the FTSE 100 as we stabilize and get the market fully open. There is a lot going on in these markets right now. The IBEX is up by around 0.6%, but are equities the kind of canary at the moment, or are other asset classes? Look at what is happening with credit. Look at what is happening with the dollar. Look at what is happening with the bond market. Lots of other asset classes moving around at the moment that are having a gravitational effect into what we're seeing with equities. So the CAC is up by 0.9%. The Stock 600 is up by 0.7%. The FTSE is up by 0.9% as well. Maybe not the underperform we anticipated that it might be. We'll wait a few minutes. We'll see what happens with the DAX. The SMI is going to be interesting as well, given what is happening with that currency story. Kriti, sectors, what are you seeing?
Well, broad gains across the board. I'm looking at a Stock 600 where most of the stocks, 510 right now, are up about 58 down on the downside. So broad gains across the board. We're not coming with as much momentum as we've seen in the last couple of days. The volatility seems to be coming down just a little bit. We are still waiting for a couple of these stocks to open, but it looks like energy is on the back foot this morning. Looking at BP, Shell, Total, among several other commodity names that are taking a little bit of a breather, perhaps that coming off of that currency play. In the leadership, though, it's tech, it's healthcare. So to me, this screams defensive from the get-go, Guy.
Absolutely, which is understandable. Everybody's looking for the defensive trade right now. Look at what is happening with the yen. Look at what is happening with the Swiss franc. Why should equities be any different? But we are in positive territory, and we are up. And in some ways, the kind of the midweek bounce that we've had for equities has stabilized the situation, at least in that asset class. Like, we're not down that much peak to trough at the moment. We'll talk about that in just a moment. Quick look at what is happening with the gilts trade as well. I just want to talk about the GDP data that we had out of the UK a little bit earlier on. Probably just worth focusing on that. We have seen GDP beating. There was a surge in Q1 25. The expectation certainly is that this is likely to fade, given what we're seeing in terms of the broader narrative that is whipsawing the UK at the moment, affecting Rachel Reeves, affecting her kind of mathematics right now, and certainly affecting exports. So there's a lot going on. Headwinds are growing, but the data at the moment, the latest data, at least is holding up.
Absolutely. So some potential good news there. I just want to bring up very quickly one stock to everyone's attention. That is BP this morning. Is one of your sole underperformers, trading down by about 1%. Some news flow coming out from this morning saying that they're issuing a warning of rising debt amid lower output and weak gas trading. This is significant because, as Guy mentioned earlier, that if you are talking about the positive in terms of gas prices at the pump, for example, or less production or any of that happening in the commodity space, BP is a key name that is going to get hit. So that's going to be one that we're keeping an eye on in terms of underperformance. Let's bring in an expert and go right back to the macro. Henry Allen, macro strategist over at Deutsche Bank Research, joins us around the table. Are you alive? Are you well? How's this week treated you?
It feels like I'm firefighting on about 5 different fronts this week. Clients are kind of ringing us off the hook, and in this job, it's hard to say we don't know, but at the end of the day, we are trying to predict what one man, Donald Trump, is going to do next, and that is making it incredibly difficult. I think professional speaking, the confidence intervals are very, very wide right now. But I think since we've had the delay in the tariffs, yes, that's kind of put perhaps something of a floor on the market, but there's still a lot of nervousness because Firstly, we've still got these 10% baseline tariffs that are still in place. So that's a huge trade shock relative to anything we've seen since World War II. And then because there's this 90-day extension, this chronic uncertainty that has already been such a problem for markets and for businesses trying to plan, that chronic uncertainty is just extended out till July.
When it comes to hiding out, when it comes to this confidence interval, everyone's talking about repatriation of dollars as a trade, this unwinding, this going back to neutral. Is that what this is? Is this short covering? Is this simply unwinding like very long positions? Or is this an actual change in the fundamentals that's explaining this massive move?
I think it's a bit of both. I think perhaps the US exceptionalism narrative was a little bit over-egged, particularly at the end of last year. But then I think also there is this broader kind of confidence crisis coming into play, that the way we've seen US assets across the board, even traditional safe havens like the dollar, like US Treasuries, unwind, despite the fact we're seeing periods of intense stress, is unusual. Because even in the debt ceiling crisis of 2011, a crisis that should have been problematic for Treasuries, given we were talking about default risk, Treasuries rallied in that environment. And even today, they're not.
So what does that tell us? Is this, to Chris' point, a paradigm shift? If that's not happening, the whole financial system is based on the fact that Treasuries are risk-free. Are they still risk-free?
I think so, because at the end of the day, if Treasuries did see an aggressive sell-off of the sort we saw perhaps during COVID-19 or turmoil in the GFC, I think the Fed eventually would step in and intervene. I don't think we're at that point yet at all, but we know from previous...
Wouldn't that just accelerate outflows? That's monetization, that's all kinds of other issues that... Isn't there a danger that you end up in a situation where there is no obvious halt to it because the Fed steps in?
Well, I think one thing central banks have proven very adept at doing in the last kind of decade and a half is that often they can leave a threat on the table and never use it. I remember the ECB and their kind of Draghi, whatever it takes, outright monetary transactions, never even had to use it. Yeah. Just that credibility underlined to stabilise the situation. So, there's tools that central banks can use like that if they need to.
Do you stay invested right now?
I think, the risk is from a retail investor point of view, the risk is you panic and then you sell, and actually that's kind of the point of the bounce back.
What about portfolio managers? Do they stay invested? There's a lot of, as you say, the outcomes at the moment are enormous. How do you, as a PM, manage your risk at this point in time, given just the breadth of outcomes that are possible?
So I think you should, and the reason is that there are a lot of natural corrective mechanisms that will, I think, mean that if the US does go into a downturn, I don't think it will be too severe. Firstly, the Fed have a lot of space to cut rates if they need to. If the labour market starts to turn down, this isn't like the 2010s.
Don't they have an inflation problem?
They do, but if the labour market starts to turn down, I think as we saw in September, clearly they can shift very quickly when they want to. We got an emergency 50-bip cut in response to a very modest rise in unemployment. I think if that rise in unemployment were more substantial, then we could see much more aggressive cuts as the Fed fear a demand shock.
There's a narrative at the moment that in the absence of this U.S. exceptionalism or this U.S. safety, that Europe is the answer, and specifically the German bond market is the answer, to the point that it's yielding more than U.S. Treasuries are right now, and it almost feels insulated from that. What happens to this market that is pricing in that full investment that's been promised? What happens if we don't get it?
You mean from Germany?
Yeah.
Well, I think we will, because, Friedrich Merz has just reached a coalition agreement. They've managed to change the constitutional debt brake. It seems as though the procedural barriers in place have now been lifted. Clearly, there is now the risk that alongside the positive impulse from the fiscal stimulus, have a negative shock from the tariffs, assuming those do come into place. Clearly, we've got this 90-day extension. But I think on the fiscal side, that looks as though it's pretty much a done deal. I really don't see too much risk that wouldn't happen.
So if there's an inflation shock in Europe, in line with the rest of the world, if there are, I know that Europe doesn't lay off people as quickly as the United States does, to be fair, but there is a larger demand on things like public services, which are already crumbling, by the way, across Europe as well. Does that pool that's been allocated for defense spending or infrastructure spending, not just in Germany, but in France, Spain, Italy, et cetera, and that gets reallocated to deal with the inflation shocks and the labor shocks and whatever else, is that a pain point then that eliminates this kind of safety or perceived safety of European assets right now?
So I think the risk of that money being reallocated away from defence is pretty low, so long as kind of the Russia threat to Europe remains live. We've seen throughout history that when Europe, and indeed many other countries, face a national security threat, indeed, as we saw in February, when Trump and Zelensky had the blow-up in the Oval Office, priorities can shift very, very quickly. It's a cliche that kind of national security is the most important point for any government, but actually, if you look through history, when the world wars began, when other crises have began, resources can be reallocated to defence, taxes can rise, fiscal policy shifts can happen incredibly quickly that couldn't in any other environment. So I think the risk of that is low, particularly with the US security guarantee that has sustained Europe for the post-World War II environment, particularly with that looking off the table.
Where does this all end? The range of outcomes are absolutely enormous. But if you're an investor, if you're trying to invest right now, if you're trying to say, I want to invest for the next 5 years, where does this end? What am I investing into? What am I discounting against?
So I think, and we saw this in Trump's first term, that there may come a point, perhaps in the next kind of 6 to 9 months or so, that even if this chronic tariff uncertainty remains, we'll kind of get used to that as a fact of life. You know, we are at this point less than 3 months into the Trump second term.
Right.
You know, indeed, we're less than 2 months since he started going aggressively on the tariffs on places like Canada and Mexico. So, you know, yes, there's been obviously this very aggressive sell-off that we're reacting to, but, you know, bigger picture, taking a step back, as I suspect we look at this in the years ahead, it's still quite a recent thing. And, you know, we did eventually in the first term over 2018-19 begin to price in that uncertainty just as a fact of life.
But in terms of the economic data, does it roll off? Do we get a recession? Do we get, how bad does it get? What am I investing into over the next, maybe slightly shorter term, 18 months? Does what's happening now cause a recession? We're about to get a lot of data. Maybe we won't get a lot of data from companies. What are they going to be telling us? What am I investing into over the next period? Do I need to prepare for a recession? Is it stagflation? Do I prepare for a rollback of tariffs and we go back to where we were before? Handicap the scenarios for me here.
Well, I think the great paradox is every scenario you outlined there, a recession, no recession, stagflation, a rollback, all of those are possible, even in the last week. Hence, we've seen this huge volatility. What the market is doing is reassessing US recession risk constantly. So after the reciprocal tariffs were announced, we had the 5th biggest two-day fall in the S&P since World War II. Investors were pricing in that recession because the tariffs are so aggressive. Then suddenly, he does the 90-day pause. And investors hope that isn't just a 90-day pause, that he'll then pause again and pause again and pause again, and we can avoid it. So the S&P bounces back. So investors just don't know what to price in right now. And that hard data over the coming weeks is going to be crucial. Because one thing that has actually been quite impressive is the hard data has held up. And I don't just mean things like the jobless claims from last month. If you look at the weekly initial jobless claims
this week,
from last week, up to April 5th. That data goes up to April 5th, last Thursday, I think that is. Then actually that was still at 223,000. You know, that's pretty low. You know, we're not seeing, and that does include the impact of the China tariffs, you know, 10, 20% that were already imposed in February and March. The US economy is proving pretty resilient. Now, I grant you, this is a much more aggressive step up in the tariff threat, but actually we saw in 2022, even the most aggressive Fed hikes in a generation weren't capable of taking the US economy into recession. So I think that speaks to a resilience that people are perhaps underestimating right now.
Okay, great to see you. Henry, that's the discussion, isn't it? Recession, no recession, stagflation, no stagflation. Henry Allen, macro strategist at Deutsche Bank. Thank you very much indeed. Let's take a look at the core 6 this morning, figure out what is happening here. Brief interlude before we get to Joe. Let me just show you what is happening. Ferrari is the only stock to be down. Elsewhere, you're seeing some decent gains back into the pharma space. Luxuries kind of cruising sideways. ASML bouncing quite nicely. Asian tech overnight has been a focus of attention as well. Let's stay back in the pharma sector. That's where Joe's kicking off. Over to you.
So as you mentioned, Guy, outperformance in pharma today, and particularly in Novartis. Remember the company announcing it's going to spend $23 billion in the US on new manufacturing facilities over the next 5 years, saying it will be able to produce 100% of the drugs that it sells in the US in the country, given the tariff backdrop. So we are seeing some outperformance, potentially alleviating some tariff worries for that stock today. Then another pharmaceutical stock doing well is argenx over in Belgium. The company saying it's got FDA approval for one of its drugs that treats a muscular disease. So that is boosting that stock today pretty significantly as well. We're up around 4%. One of the best or other pharmaceutical stocks gaining today. Then I wanted to check in on chips because we are seeing decent outperformance, probably the best performing sector in terms of the smaller sectors on the board today. So we have seen big declines, of course, in this space this week. Some of these stocks down 20% on a year-to-date basis, but seeing that trimmed at the moment. Then in terms of Logitech, remember this company was hit hard by the tariff news because it makes a lot of its computer hardware in countries like Mexico, imports them into the US, and actually removing its guidance yesterday after the close, so extending that loss, now down around 30% almost for the year on that one. Then over in advertising, Havas, this was one of the firms spun out of Vivendi a few months back, the advertising and PR firm, reporting some strong economic growth today for Havas and gaining almost 7% in Amsterdam this morning. And then finally, just finish on BP, because they have given that update, as Kriti mentioned earlier, with weak guidance on production on upstream oil production, according to the company, and also downgraded at UBS today for exactly that reason, given the oil price drop. So BP coming down 2.5% in London this morning.
Joe Easton from our equities team, we thank you so much. I'll add one more negative there, and that is Stellantis, down about 3% this morning after reports of their North American production drop being, I get this, 9%. So some pain there in the Italian automaker. Coming up, we're going to just pivot a little bit and take a quick look at the banking sector. Those earnings kick off today. JP Morgan, Morgan Stanley, and Wells Fargo reporting ahead of the opening bell. We'll dive into the preview next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more. It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
It is imperative that the European Union communicates to the US, but also to trading partners all over the world, the fact that we want to be reliable and predictable trading partners. It really is up to President Trump and to the US for them to determine how they want to negotiate, what their priorities are. But the EU is a long-term, stable, predictable trading partner.
Chair of the Eurogroup, the Irish Finance Minister, speaking to Ollie Crook a few minutes ago at the ministers' meeting that is taking place in Warsaw. Ollie's back with us. Ollie, what's the takeaway? What's the takeaway from Pascal? What's the takeaway from the EU at the moment? There's almost like a sort of, somebody was saying there's almost like Buddha-like calmness about the EU at the moment.
Yeah, the calm before the storm guy. I mean, listen, the way that I've been trying to think about this, because the litany of issues is so vast, how they interconnect between trade, possible recession, inflation, geopolitics, opening up new trade routes. This is all the issues that these finance ministers need to grapple with here in Warsaw. And the way that I've been trying to think about it is you have basically the question of negotiation. This is what the EU wants. They want a negotiated outcome with the United States. It doesn't help that they don't have a clear idea of what the United States wants. Retaliation, basically the architecture that they need to build around the possibility that the Trump administration does not come to the table. I think that for many Europeans, they're trying to figure out, and they're expecting and hoping that the market is going to drive Donald Trump to the table, as we've seen the softening stance, as we've seen the sell-off in U.S. equities, the sell-off in the dollar, the sell-off in long-dated treasuries, that will force Donald Trump to the table. But what if you have a recovery? What if that narrative changes and Donald Trump is more emboldened to basically take a harder stance with the EU? To what degree is the EU willing to compromise on all of these questions of non-tariff barriers, of reducing potentially food safety standards to allow what Howard Lutnick calls, beautiful American beef into the European market, to lower taxes on Europe and regulations on American tech companies? And then the question, of course, the final question here is evaluation. All the finance ministers I've spoken to over the last week or so have basically no idea really how this is going to impact European growth, other than the fact that it's going to be damaging. To what scale? What is the impact going to be on inflation? And as a consequence, what should be the European response to those to support the economy and to support businesses? Those are the conversations that are going to be happening here in Warsaw for the next 2 days.
Well, Ollie, can you explain that in the context of this almost warming to China that we're seeing? I mean, Pedro Sanchez in China right now, Ursula von der Leyen and other leaders expected to go to Beijing in July. Why this sea change or sentiment shift when it comes to opening up to the east?
Yeah, Critty, it's really interesting because when you talk to people about it here, how active of a conversation is it that basically the Europeans will have to change their posture on China, open up trade a little bit? They're very, very guarded about saying anything about really any extreme pivot towards China. For a very long time before Donald Trump was elected president of the United States, you will remember that the main sort of challenge for Europe was not the U.S., it was obviously China. That has shifted in the last few months, but at the end of the day, you also don't want to be in a position here from the European perspective where you say things and you're starting to inflame Donald Trump. But potentially it's a bargaining chip saying that, hey, basically the United States, if you're not willing to work with us as the EU, we need to start looking around. And that is something that I put to Pascal Donahue, and he was very guarded about that, but he didn't say that it does not push Europe in that direction. I think what the Europeans will also be looking for is opening trade relationships, not necessarily with China, but over the globe more widely. We've already got reports of that coming from von der Leyen and the EU opening up a free trade relationship with the UAE. You may see a lot more of that in the coming weeks.
Yep. Emmanuel Macron was posting on X a little bit earlier on, talking about the fact that the EU must continue to work on tariff countermeasures. Who are the hawks in the room right now, Ollie?
Yeah, I think the hawks in the room is certainly Emmanuel Macron. To a certain degree, you'll have the Germans. We'll speak to the German finance minister a little bit later to try to get his temperature on how hard they're willing to go. But of course, the Irish are an interesting example. They are so dependent on American tech companies. They're so dependent on the pharmaceutical sector. I think what we just heard from Pascal Donahue is that there is solidarity within Europe. They need to consider themselves a full bloc. Yes, everyone has different interests. Yes, there is a different degree to, for example, the eastern flank of Europe is more interested in military support from the United States than trading support from the United States. But these are the issues and the trade-offs that you're going to get from European policymakers as they talk today. But I think that there is a consciousness among all European policymakers that the only way that they get a good outcome, and the only way that they win in this sort of sense against the United States is if they stick together.
Ollie, great stuff. Thank you very much indeed. The French talking about a fragile pause. Ollie Crook joining us from Warsaw. Plenty more still to come from him. We're going to hear from the Germans. We're going to hear from the Swiss, Critty.
And certainly, of course, CRQ, not only from Washington, D.C., but from Wall Street as well, especially what the banks say about some of the market's volatility that we have seen in the last week or so. J.P. Morgan and Morgan Stanley kicking off earnings season today as banks and other major companies struggle to navigate Donald Trump's trade war. Bloomberg's Charlie Wells all over that story. So are we just expecting loan loss provisions and kind of doomsday warnings from Jamie Dimon? Is that what we're prepped for?
I mean, look, so there's going to be some good news coming from the past, if that counts for anything at this point in time. And, you know, we're looking like record trading revenue coming from a lot of these houses. So pretty solid numbers coming out of JP Morgan and very solid numbers, especially on that equities trading front, coming out of Morgan Stanley. But as you say, Kriti, that's, you know, what we're really going to be focusing on is the future, right? How these executives see the trade war playing out into their businesses. And I think what's so interesting and why banks are so telling right now is they're not in the direct line of fire in the trade war, but they kind of pick up the shrapnel that kind of shoots out from every other industry because they just loan across to so many businesses, but also consumers. And I think where there could be some surprises is that loan loss provision element, because you've heard Jamie Dimon talking, kind of forecasting over this week in his annual shareholder letter, also in that crucial television interview that he gave, the fact that there could be defaults coming up. And so that seems like, and you know, I could be corrected, that seems like it could be a hint that there's dark times for the consumer ahead.
But do these banks have that risk? They are, if you're looking at FICO scores, they are at the upper end of the spectrum when it comes to what U.S. consumers are doing right now. It's lower down where the risk lies, elsewhere where the risk lies.
Yeah, I mean, that gets at the kind of two trends that we should be looking at and how, you know, banks' stocks could kind of change over the coming days. The question is, do you have exposure to the consumer? And so we've seen the share prices for banks that have more kind of direct consumer exposure. Those have been going down. And they could be affected by the trade war, right, if suddenly they are less creditworthy, if those credit scores start to go down. I think the other theme that we really need to be paying attention to is the degree to which a bank facilitates global trade. And you have seen banks that do this more than others. I'm thinking Citigroup in particular. They've taken bigger hits. And I just said big, being diversified is what the market seems like it likes right now. We're going to see that the biggest of the big, JP Morgan, report in just a few hours.
Very quickly, talk to us about maybe the sea change from Wall Street. There's a little bit of tongue-in-cheek commentary out there that maybe Trump pivoted, not just because of the market, because of the pushback he's getting from the likes of Jamie Dimon and Bill Ackman.
You've had billionaires coming out criticizing this tariff policy, and we know that this is a president who maybe says he doesn't pay attention to the markets, but it seems like he certainly did this week. We also know that this is a president who watches television. And there was that interview I mentioned from Dimon midweek in which he talked in very delicate terms about how, you know, trade has been unfair, but that if we let this go on too long, it could be very damaging. And I think these comments certainly resonated, and you've got to take them into account when you think about why this policy U-turn happened this week.
Charlie, great to see you. We're setting everybody up for these numbers. Are going to come a little bit later on. We're going to have some great coverage. I'm sure Shonali's going to be all over that one a little bit later on. Shonali Basak coming up on the U.S. banking story. Coming up on this program, U.S. credit fears increasing. Investors turning their attention to corporate earnings. That's what's coming up next. Marathon's Bruce Richards will be around the table in just a moment to talk about all of this. That's next. This is Bloomberg.
In case you missed it, on Bloomberg Crypto. You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the Welcome back. This is the opening trade. We're 30 minutes into today's session. Green on the screen across the board, but take a look at this. Paring back some of their opening gains. We were higher by over 1% across the board. We are now higher by only 0.3%, but the French index still seeing a little bit of optimism, Guy.
Bruce Richards is here, CEO and chair of Marathon Asset Management in London for the week. Nice to see you.
Nice to see you, Guy.
How you doing? How's the week been? How you feeling?
I'm doing well. In crisis back in 2008 and 2020, a lot of angst, and the gut was just churning, and the nervousness was up, and a lot to figure out. This time around, I got to tell you, I'm as relaxed as I've ever been, given the volatility that we're having. And the reason is because just at our firm, our position's in such good shape, and we had a very good feel of what was going to happen with respect to tariffs, and we leaned into non-cyclical businesses that didn't have impact from tariffs, so we're in a very good spot. In terms of the markets are still rocking, they're volatile, there's a lot to figure out, but it's exciting times. Not exciting times for great reasons, but exciting times in terms of what's going on in the news cycle.
Okay, so let's talk about the exciting times. You talk about the fact that you think the portfolio is in great shape right now. How confident are you that that remains? Are you playing offense? Are you playing defense? More critically, actually, within that, what are you turning down right now? What are you avoiding?
So we're avoiding the big exporters, the big importers, the companies that have those exposures. We're avoiding the big cyclical companies because, look, economic cycle is going to slow. Whether it's a recession, which I don't believe we're going to be in right now, and I think it's more stagflation, which is slow growth, higher inflation. So you have to avoid the consumer cyclicals and the commodity-based companies. And so that's kind of where we lean in and lean out. So it's about non-cyclical businesses that have low level of leverage, that have nice operating margins. And so when you have this rather large tax on corporate America because of the tariffs, because look, you have a $30 trillion U.S. GDP, $300 billion to $500 billion in revenues that the government wants to take in the U.S. based upon $3 trillion of imports. 10% imports of $3 trillion is about $300 billion. If they get to a slightly higher number, call it $500 billion because there's China involved as well at higher tariff rates. And that comes right out of corporate earnings unless they pass it through to consumers. And so they'll do both. It'll be a hit to earnings. This is a direct hit to corporate earnings. And that's why the multiples are coming down, and that's why the risk is being shown up shown in equities. And so we're avoiding those equities. We're credit investors, but those equities that have that type of exposure.
So we've heard all week that credit is leading the equity market, that the spreads, the spread blowouts that you're seeing, the default risks across the board is what's freaking out the equity market. Would you agree?
Yes and no. I mean, the first hit, the first derivative is this is a hit to corporate earnings. And so it's a repricing of equities. That was the first leg down, and you saw credit actually hold in. Credit has recently started to break because the break in equities is so severe that people are wondering, is this a recession coming? We better price credit spreads wider. Default rates will undoubtedly rise. There's no question about it. That's a lock. That's a given. Why? Because you have so many companies that are exposed to, the import and export pressures and the hit to margins, and they're too highly leveraged for this environment and the slowdown in economic activity. So default rates will rise. Having said that, this is very, very important. High yield spreads, although they've widened, are just at around average, and they're holding in rather well. And so when you have a recession, the high yield bond index, the spread is around 750 off. Where are we today? 450.
Yeah.
So yes, we're out from the 300 level, or we're out from the tights, but we're about average. And so spreads are not saying recession, and treasuries are not saying recession. And so what the fixed income and credit markets are saying is no recession, and what the equity markets are saying is earnings recession, not necessarily economic recession. And so that's my base case right now is stagflation, slower economic growth, higher inflation due to tariffs, yes and yes, but not recession yet. And so the betting markets are saying, poly markets or, consumer credit or consumer sentiment, I should say, CEO sentiment, they may be pointing to recession, but that's sentiment, and sentiment changes pretty quickly. The hard data is still pretty good. GDP numbers, employment numbers. We just had 228,000 jobs created in the U.S., up from 150,000 jobs. And when you create 228,000 jobs, doesn't feel like a recession because you never, ever have a recession when you have that type of job creation.
But the risk here is not necessarily the job creation that's existing, but that if you see so much volatility around tariffs or shipments or pricing or whatever, suddenly businesses panic, they lay people off, and that optimism around the jobs market flips very quickly.
We'll see if that comes. We're forecasting right now based upon sentiment and what the markets are telling you, as opposed to what companies are actually doing. Companies are still hiring, and so I haven't seen that yet. When I start to see the hard data, I'm with you. Until we see the hard data, I'm going to fade that a little bit. Probabilities have gone up, no question, agreed. But I'm going to fade that a little bit and say, okay, the economy, as opposed to growing at 2%, real GDP will probably grow at 1 or maybe sub 1, but not yet a recession. Inflation, 3% might tick up to 4% with the tariffs. That's where I'm at right now.
Are you keeping powder dry, waiting for better deals? Are they going to be, as the economy sort of maybe rolls over, there are going to be better deals coming?
We have a lot of dry powder. Credit spreads are wider. That's good for us as lenders.
Yep.
And so, again, lending to non-cyclical businesses, lending to companies at low levels of leverage.
But are you holding that money back, waiting for better deals to come?
Oh, yeah. We haven't put a lot of money to work in the last couple of weeks because we want to see where things settle in. And there are better deals to come in the months ahead. When you see some of the damage being done, we'll do that through capital solutions. We'll do that through direct lending, and we'll do that in a very big way in asset-based lending, because a lot of companies have a lot of hard assets that they can use and pledge that we can lend against the hard assets, so we're less reliant on the company's EBITDA and looking more to the collateral as well.
The U.S. 10 years risk-free? Is the U.S. Treasury market risk-free still? It should be the risk-free asset.
Well, when you say risk-free, yes, the principle's risk-free. When you talk about price, absolutely not, right? So, look, what's happened in Treasuries is a very interesting case study, and something that actually related to the Trump put, if we want to refer to that, when he dialed back that 90-day, holiday that he's giving, and meanwhile keeping 10%. So what we saw first is U.S. Treasury 10-year notes traded to around 370, 380, which was too tight given inflation's coming. It should be trading at a much higher yield, not that lower yield. So the first kind of knee-jerk reactions. Let's sell treasuries. The market came up with that. The second knee-jerk reaction is China saying, time out. We own nearly $1 trillion U.S. treasuries, and we're not taking this. We're selling down our U.S. treasuries, and they're doing that
China's
in the marketplace.
selling, yeah?
They're selling U.S. treasuries. After you sell U.S. treasuries, a day later you get your dollars back from having sold it, and then they're dumping dollars, which is causing dollar weakness. That's the second thing that's happening. Third thing that's happening is about $1 trillion plus is in these basis trades that the big hedge funds run, where they're long cash, short futures. They're unwinding those positions. Swap spreads are collapsing. This week we had 3s, 10s, and 30s, 120 billion being auctioned. It takes weaker prices to underrate in this market environment. So safe haven, it's not lost in the U.S. Treasuries. Price backup, because of all the natural selling, is there. If Treasuries break much further, you have QE by the Fed. Well, they may not cut rates, but they're going to step in a very big way and start to ramp up their portfolio to support the Treasury market if need be. I don't think we get there now, but that kind of big bazooka, as referred to, is definitely there to support the marketplace if needed.
Okay, so 2 follow-ups to that. Let's start with I'll ask you the private credit piece in just a moment, but I want to start with the Fed, the QE bit here. There's an argument that under any other circumstance, under any other era, this kind of volatility would already expose cracks in the system. And we haven't seen that because there is still excess liquidity in the system, even in the absence of a Powell put. We kind of got a Trump put, but in the absence of a Powell put. If Chair Powell doesn't come to the rescue, if he doesn't have that QE moment you've just outlined, what happens?
So break it down to its pieces. I think Jay Powell wants to hold firm with respect to inflation and be vigilant, not lowering rates, because I don't think he believes that tariffs should be raised as much as they are, and that's a self-imposed problem that came out of Washington, as opposed to, kind of a greater issue. I believe fundamentally he believes that. And so he's going to hold firm because he's worried that inflation will come and as a result of tariffs, and so he'll be reluctant to ease into this. He should be easing on May 7th, I believe, because I believe the economy will weaken, and he should be easing as a result. But he's not going to ease, I believe, on May 7th, and he may not ease in June, although the markets are telling you he will. But I do believe that although he may or may not ease because of the inflation risk, he will definitely use the Fed balance sheet to support the Treasury market if all of a sudden there's some risk, as you say, Guy, to that safe haven bid. So there are 2 different things. He'll provide liquidity facilities for those that need liquidity because the banks are pulling back risk. And so a lot of fund managers that are long treasuries that may need some liquidity, he may make that available. He hasn't done it yet, but if there's an emergency that requires that, that'll be available. QE will be available, but I don't believe, because I think he'll wait until he eases, and I think he'll want to see more information around inflation. Look, we got a very good CPI print yesterday. For the first time in 5 years, the headline CPI number fell by 0.1%. And so it's very good news because led by oil having been softer, airlines and fares as well, and other elements led to that softness, but led by commodity softness and particularly energy. And so there's some favorable signs in the short run for inflation, but longer run we have a firm view that inflation will probably pick up with firmer tariffs.
So that's the public markets. Let's talk about the private markets here. Especially in this era where so much of the private markets are taking on the lending and the risk-taking ability that I would say the banks took on, say, 10 years ago or so. Jamie Dimon has famously said that the private credit is looking like the housing market of '06 right now. With this volatility that we're seeing, if there are cracks in private credit, does that mean the rest of the market is maybe immune to it, that ripple effect doesn't exist the way that maybe it did or would have 10 years ago?
The Fed raised rates 525 basis points in a blitzkrieg period over a 1.5 year period of time. And so that was funding costs for private companies that was like really punishing, right? Instead of paying a 5% rate, they were paying a 10% rate. And they sailed through it. What happened? Default rates went up a little bit. Private credit managers made 10, 12% through that. So no pain at all. Now you say, okay, there's going to be some issues. So, yeah, default rates will go up because there's going to be some issues. Is private credit the resi market of the GFC in 06 through 08 that Jamie was referring to? No, I mean, private credit is so important because think about it. Banks are pulling back right now. They're not making their lending facilities available, for certain companies coming through. And thank God we have private credit that's stepping up making these loans. It's a great circuit breaker.
Isn't that the risk, though?
It's risk and it's opportunity. Because I got to tell you, like like you mentioned, Guy, and you indicated, when times like this occur and spreads widen and we can lend at really attractive rates at wider spreads for companies that are non-cyclical businesses at low level turns of leverage, we're doing that all day long. And so our phones are starting to ring off the hook now in terms of, deal flow that's coming in for folks that need financing because banks are pulling back and the markets are tightening up, the public markets are tightening up, and financial conditions are tightening up. And that's when we do our best work as a lender, not of last resort, because lender of last resort is the Fed, but lender of last resort in the credit markets. We can make really great returns.
What kind of returns are you looking at? Give us some numbers.
When liquidity dries up, the opportunity expands for us private credit lenders. And so, look, we just, did a big engine deal with one of the big OEMs, $600 million transaction, and we think we'll make a mid-teens return on that. We're lending to companies in the ABL space, generating 10, 12% net IRRs, and in direct lending, same type of returns.
Do you think overall the cost of capital, the cost of money in America is going to be higher, though, as a result of what is happening right now?
It should be. It should be higher as a result of what's going on. Absolutely. So,
and does that logically mean a slower rate of growth?
Well, look, the Fed raised rates 525 basis points, and they've since lowered rates 100 basis points. So the front end's come in 100 basis points. So if rates go back up 100, 150 basis points at the front end in terms of where we'll make that loan, we're back to where we were a year ago.
Do we get a slower
and that's
rate
a beautiful
of growth?
Thing for my investors and for our rates of return. Do we get a slower growth? Listen, I think we're going into slower growth. Here's the big thing with stagflation, and it's a very important fact, and it's a very important data point for your viewers, your listeners to understand. When you have stagflation, and there are not a lot of data points, but it's what we've seen. We haven't seen it in the U.S. in decades, since the 70s and 80s, but there's been some episodes of stagflation here in Europe. And what you see is gross GDP doesn't go down. So if you have gross GDP in the U.S. of 5% GDP, and you have nominal GDP of 2, that is, you had inflation of 3, you're still going to have gross GDP of 5, but you're going to have 4% inflation, which only gives you nominal growth of 1. So we're going to see GDP fall on a real basis, but the gross level of GDP probably not fall. And so higher levels of inflation, lower real, but the economy overall will actually do as much volume as it did in the past. And so you have to really just invest wisely. Invest in a non-cyclical business as a lender. At low levels of leverage and get paid really rates of return. How do you not love that, Guy?
It's your business. You've got a smile on your face. Bruce, safe travels.
Thank you.
Thank you for stopping by to see us this morning. Great to see you. Bruce Rich is the CEO and chair of Marathon Asset Management. Thank you very much indeed. Coming up, a week of terrorist-induced chaos, testing U.S. exceptionalism. We're going to discuss the security implications of all of this. MI6's former chief, Sir Richard Dearlove, is going to be joining us. I guess you could probably call him. That's next. This is Bloomberg.
so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Now, of course, we know that the markets have been selling off all week. A very volatile session, positive in equity territory this morning. But when you look at some of the U.S. assets that we're seeing a sell-off in treasuries. We're seeing a sell-off in the dollar as well. What does that mean in terms of the credibility of U.S. assets and the U.S. by largely extension? Let's have that conversation with Sir Richard Dearlove, former head of MI6, the UK's secret intelligence service, and host of the One Decision podcast. Sir Richard, a pleasure to have you on this program.
Very nice to be here.
We're thrilled to have you. It's a perfect conversation because, again, throughout the markets, we're hearing this idea that the U.S. credibility story, the safety from a financial market perspective, just isn't there anymore. How trustworthy is the U.S. right now from an economic lens, from a security lens, from an intelligence lens?
Well, I would separate the economic from the intelligence exchange. A lot of the intelligence exchange between the U.S. and its allies is to an extent institutionalized. So it goes on in spite of other political crises. So I've been trying to explain to people that if you take the special relationship, which is the core of Five Eyes, that is based on a treaty which dates back to 1947, and it operates almost as an institutional relationship. Okay, a lot of questions are raised around that when there's so much uncertainty and unpredictability, but it still carries on, and it's never been, a black and white relationship where everything everywhere is exchanged and discussed. It is in part selective. Stuff's withheld sometimes, it's not withheld on other times. I mean, there are generalizations being made by the media about intelligence relationships, which frankly are exaggerated and misleading, because unless you've been on the inside and understand how it operates, it's very, very hard to make an informed commentary. I'm trying to say to people, look, a lot of what's happening at the moment is sort of optics. We haven't reached outcomes. I think the worry is that people are so uncertain about what the outcome might be, therefore they tend to assume the worst. And I'm not an economist, and the markets have certainly reacted very heavily to that uncertainty. Everybody hates unpredictability.
Yeah. How predictable is Donald Trump?
In certain areas, pretty predictable, because a lot of what's happening he actually said he was going to do. People
why is everybody? Why he's? It's interesting. You sat down and said he's doing what he said he was going to do.
Yeah.
So Why are we surprised by what? Is it the order of magnitude? Is it the scale?
Frankly, personally, I'm not surprised. But I suppose it's the scale, the intensity, the speed, which has caught everybody by surprise. And I mean, what's interesting is, okay, we have a 90-day suspension on a lot of the tariffs, which is not a plan. I think that's a reaction to the bond market. I mean, I think we all know, in fact, it wasn't a plan.
Yeah.
I mean, the media are pretty authoritative in reporting that, and I believe they've got it right. So the idea that, Trump planned a 90-day suspension, no, that doesn't wash.
Okay.
But the separation of China and the treatment of China, look, this is the commercial relationship with China is it's a 20-year, it's been running for 20 years. We let China into the WTO on terms they should never have been given. And there's been a continuous attempt, which has slowly escalated, to sort that out. It's come to a head. I mean, I'm pretty sure, given the fact that, we have intertwined economies with the Chinese, this is not the Cold War. It's something completely different. Yeah. So at some point, it'll be negotiated out. But where we'll be...
Yeah.
This isn't a secret, it's a mystery. I mean, I know that's a cliche.
Yeah.
Well, Sir Richard, as we speak, we have EU leaders, including Ursula von der Leyen herself and Pedro Sanchez of Spain, looking to China to force those economic ties.
Well, I've just been in Madrid and trying to explain in this conference in Madrid that, for Pedro Sanchez to go to Beijing 3 times in 18 months, and develop, I think, an alarmingly close relationship with China, when there should be consistency amongst the EU nations into how to handle the Chinese relationship. The problem is the Chinese are very expert at splitting off individual countries and developing initiatives to make sure there's not a unified response. So
where does the UK fall on that?
Well, the UK falls, fortunately, in a very independent position, because we're beginning to see the benefits of not having our foreign policy dictated through the European Union. I mean, Brexit has put us in a good place. We can talk to the Americans in a particular way. We have had a fortunate outcome at the moment on tariffs, and we are not in the EU, but we have a very influential voice when it comes to European security. And I mean, my position during Brexit was that our most powerful card to play with the Europeans, and it's come back now, as it were, was our defence, security, intelligence contribution to European security.
How would you play that card?
Which is indispensable.
How do you play that card?
Well,
just briefly.
The security of Europe depends on British participation. We're the natural intelligence and security leaders in the European, if you take continental Europe, including the UK, we have strong bilateral links with every single European nation. We are the lead in this area. We have been for years.
Yep.
You can't dispute that. And, okay, we've disastrously run down our military over the years, but it's being rebuilt. The government have committed to 2.53%.
Okay.
And we're going in the right direction. But, to change this narrative, it takes a long time.
On that note, we will leave it. Sir Richard, very nice to see you. Thanks for stopping by to see us. Sir Richard Dearlove, former head of MI6. The weekend is almost upon us. Justin Rose is 7 under. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The U.S. president admits his tariffs may have caused transition problems as the White House clarifies that China now faces import levies of 145% while markets continue their roller coaster ride. The Spanish prime minister says China is a partner of the EU as he pushes for a closer relationship during a trip to Beijing. Plus, the UK economy surprises with a 0.5% growth in February, the strongest in almost a year. So there is a lot going on. First of all, well done, everyone, for making it to Friday. We've seen so much volatility, and just the amount of volumes has been pretty incredible. I think we had a record high on Monday, then Tuesday, and again Wednesday. Now, the picture across the board, currently, S&P futures down some 0.2%. Look, it does seem that things are stabilizing somewhat, but there could be surprises longer term. There could be a bout of volatility as, again, a lot of the banks, for example, go through second-round effects, and a lot of equities and also supply chains move across the world. Euro-dollar 113.67 yesterday. We had a great conversation with Jeff Curry on where the price of oil is headed. Currently today, Brent crude at $63. A couple of other things we need to watch out for. UK growth surging again. This everything has to do with factory boosts. And then if you look at dollar and of course stocks are also dipping. There's a bit of a reversal on the mood. Nothing huge, but again, just watch out for some of these indications. You can see the DAX down some 0.6%. Milan down 1%, and the CAC 40 down 0.3%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, U.S. stock futures pointing to gains at the end of one of the most intensely volatile weeks in decades. Investors grappling with the fallout from the global trade war. Now, President Donald Trump has acknowledged his tariffs may cause transition problems, but has expressed confidence in his plan. Now, that's after the White House clarified that U.S. tariffs on China have now risen to 145%. Trump says he would like to make a deal with Beijing.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond anybody, nobody. How people stood for it sitting in my position is not even believable.
Meanwhile, the Spanish Prime Minister Pedro Sanchez has met with China's Xi Jinping in Beijing, where he stressed that the trade war, of course, does not have to get in the way of retaliation between the EU and China. Now, for more, let's bring in Ross Matheson, Bloomberg EMEA News Director, and Christian Mueller-Gleesman, Head of Asset Allocation Research at Goldman Sachs. Ross, in the last couple of minutes, China has announced tariffs on the U.S. This feels like actually quite a significant escalation. China will increase tariffs on U.S. goods to 125%, and it's announced these additional tariffs on U.S. goods. I mean, we thought that China was a bit in a wait-and-see situation. It feels like they're going large.
Well, certainly they are. As you say, we just got news a few minutes ago that China is retaliating again against the U.S. retaliation, so it's hard to tell who's retaliating in what way at this point. But China's now saying they're at 125%, and Donald Trump saying that U.S. tariffs are on China at 145%. So we're in the realm of just endless tit for tat, it seems, at this point. But the message very much from China is we are going to escalate if you're going to escalate. Whether that creates the room that Donald Trump is talking about for conversation at some point, it probably still does, because Xi Jinping and Donald Trump are both pragmatic enough to know that they probably should talk to each other if there is that opportunity. But how do you get agreement and understandings to talk in a climate like this? But certainly China sending the message again that they're not going to start to slow down in the face of Donald Trump's escalations on trade.
Yeah, and Christian, I guess this is, what everyone was waiting for. Does China kind of stand still and try to negotiate, or do they ratchet it up? Is this just going to escalate and escalate, or will there be common minds at some point?
Yeah, I think the uncomfortable thing for markets right now is this escalate to de-escalate idea. I mean, you've seen that to some extent with the reciprocal tariffs and the 90-day pause. Like, you had an escalation, and eventually there was a pivot. And the market has the same to some extent with the US and China. Where does it get worse enough? And the market never likes things it can extrapolate, and it never likes things that cause uncertainty. So the more you escalate, the more you cause uncertainty. So I think in summary, as of now, it seems like negotiations, escalations, and the market will price this increased uncertainty until you have to pivot.
Yeah. Who blinks first, Ross, I guess is the question, right? And is this just geopolitics, or is this about the economy? Yesterday, we also know that China really took quite a lot of time to try and figure out whether they could support the economy to a point where they felt comfortable, with an escalation.
Well, Xi Jinping probably feels fairly comfortable. I mean, they've done quite a lot of work in China to diversify their economy away from the US. You can see that in the way that the trade has risen with other places and the kinds of goods that they're shipping to the US versus what they're importing from the US. So they can possibly weather it a bit better in terms of the direct impact on consumers. For the US, it's much more direct hit on consumers. Xi Jinping is also doing a lot to try and boost consumption in China. We're expecting more from that, possibly even today, more announcements on stimulus from China designed to juice their own economy. But equally, they do have their own bases to think about here. Xi Jinping needs to look strong for his domestic base. Donald Trump needs to look strong that he's standing up to his own voters. So when you've got two leaders who both need to play to their bases, both need to look strong, how do you thread the needle through that to get to the point that you can talk to each other without looking like you blinked first? And so that's the difficulty. How do you navigate through this? They probably do want to talk to each other, but they can't be seen to be backing down.
I was going to say, what's the likelihood of the two leaders actually meeting?
Well, very unlikely they'll meet in person in the near term. Interestingly, we saw news today that Xi Jinping is inviting EU leaders to come to Beijing again, and that's a fairly regular thing, but the last visit was also to Beijing, so he wants to host them in Beijing. This is the Brussels leadership. We saw that news coming out this morning, so he's certainly making sure that he's keeping all his options open. A sit-down meeting, that's a really difficult thing to arrange. Even a phone call seems quite difficult at this point, but you'd have to start with phone calls and build up to a level of understanding to have a sit-down meeting.
Christian, when you look at, again, the market volatility has frankly been crazy this week. I know Goldman also changed your call on a recession. With tariffs going up from the China side, is a recession in the U.S. even more likely?
Yeah, I mean, any tariff and any uncertainty is not good for growth and increases the risk of a recession. And I think the financial conditions tightening is really the most important thing to watch right now, because what you've seen yesterday is the equity market selling off together with the treasury market. Right. And that, to some extent, is a tightening of financial conditions, which shows us that's going to cost growth. And these financial condition shocks, according to our economists, go into growth very, very quickly. So in that regard, I think the kind of high-frequency indicator for recession risk is the market, and the market and the financial conditions are tightening, so recession risk is going up.
Okay, Christian, let's listen to the president actually talk on Europe, and then we'll get back to see how you play European equities right now. Here's the president.
They've been very tough, but they were very smart. They were ready to announce retaliation, and then they heard about what we did with respect to China and others, but China. And they said, you know, we're going to hold back a little bit. Look, the EU is very smart, but they really have taken advantage of the United States. They were formed for the purpose of taking advantage of the United States.
I mean, it feels like, you know, the President of the United States is saying that Europeans capitulated, which is not at the moment what happened, Roz.
Well, the EU's been walking the steps and doing that quite carefully, but always knowing and making clear that they've got stuff in the arsenal. But also, under their rules, there are only certain things they can do across a complicated time frame. They're actually bound not to be loading tariffs on the back of each other. That's just part of their own rules, and so they are abiding by that. But equally, you know, seeing that the pause did come, it makes sense for the EU to say, okay, we will hold off ourselves on that, but they are making clear that they've got all these things in place. They can enact them pretty quickly if needed, but obviously wanting to leave room for negotiation. I mean, Donald Trump keeps saying he wants to talk to all these countries. He personally wants to be involved in these conversations. And, you know, there's a lot of talk about 70, you know, 80, 90 countries all lining up to talk to us, and we're going to get deals. Those will obviously take time, you know, so it makes sense for the EU to play its cards carefully.
So, Christian, when you look around the world, how do you build the perfect portfolio or a portfolio?
Yeah, I mean, listen, I think one thing you clearly have learned this year is that international diversification is getting much more important.
Yeah.
Kind of FX overlays will get much more important, major regime shift for the dollar. So I think, like, you want to think about diversification across and within assets much more than you have in the last 3-4 years, but the last 15 years, where the US assets, equities, the dollar, they've completely dominated in terms of size in your portfolio. So that is a major rethink. And then the other thing is obviously about safety. What is safe if the treasuries aren't, if the dollar isn't? And so we discuss a lot the Swiss franc, we discuss the yen, and obviously gold. That's the kind of like crude instrument. If nothing works, you go back to gold. It has a few hundred, if not thousands years of history, which you can't argue with.
What do you think happened with treasuries this week?
Listen, I think it's very difficult to say because there's multiple things at play here. I think, first of all, you have, from a market microstructure perspective, from a liquidity perspective, a lot of concerns about the owners of treasuries and who's currently selling. Then you have a fiscal deficit of 6% and the prospect of a US recession. That's very seldom that you have such a large fiscal deficit going into a US recession. Then you have a lot of concern about the long-term outlook for debt anyhow, globally. So I think put it all together, I think the treasuries will not be buffering equities as we like. But really important to keep in mind, bonds are not that risky. So the fact that the bond yields are going up a bit means that you might lose 1% or 2%, whereas in equities you can lose 1% or 2% literally every hour. So from that perspective, we are still advocating that you want to have a bond allocation. I think the bond allocation might have to be diversified internationally. You might want to be a bit shorter duration, but it doesn't change the fact that bonds are a core part of a risk-off portfolio.
Christian, yesterday I also spoke to Ray Dalio about the reliability of the U.S. longer term, and this is what he had to say.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
So, Christian, do you see this as a medium to longer term problem, or could it be, coming to bite the U.S. sooner?
I think the market is currently looking both at the cyclical risk, as you mentioned, the recession risk, but there is some structural risks as well. So the US and President Trump wants to get manufacturing back into the country. And the problem is that the equity market is not very exposed to that. The equity market is in large cap tech, capital-light business models that are very profitable. And if you now see some of the policies that make the American manufacturing come back hurt these profitable companies, And what we actually showed is that the US equity valuation exceptionalism, like both relative to its own history and the rest of the world, can be explained by only two variables: low and anchored inflation in the last 20, 30 years, and rising and high corporate profitability. So if the tariffs are threatening that equilibrium, the market needs to rethink, to some extent, the longer-term equilibrium for equity valuations in the US, and that's more structural.
And I guess on the structural longer-term implications, Roz, I mean, I know there's a lot of chatter on what the U.S. would do if Taiwan were to be invaded. I mean, many question marks, but is there really a geopolitical vacuum that China could fill, actually, in all of these kind of uncertain times?
Well, there's a lot of countries trying to fill vacuums at the moment, so you're seeing a very interesting recalibration of relationships around the world, and what that settles in, we really don't know. But it does seem that, you know, a lot of countries are saying long-term reliability question for the US, you know, as a partner here, whether you're an ally or whatever, you know, that's changing. And so that's a deep structural change that washes out in ways that we just can't see at the moment. But we do know, for example, I mean, the EU is talking to the UAE about different kinds of trade and other understandings. These relationships are moving and shifting now quite quickly, and the role of China in that, again, with the Spanish leader in China today talking up a balanced relationship with the Europe and China. That's a very different kind of conversation. I mean, he doesn't represent all the views of Europe in that. There are some concerns about going too quickly towards China again in Europe, but it's interesting those conversations are happening. And so whether, you know, it's only been a few months of the Trump administration, it might feel forever. It's only been a few months. We've got years of this yet, potentially, to go, and then whatever comes after the Trump administration. And so we're in a much longer-term recalibration of global relationships, and that's going to have a lot of knock-on effects.
I feel like the last 5 trading days were forever. Roz, thank you so much. Roz Matheson, Christian Miller-Gleesman from Goldman Sachs stays with us. We'll talk a little bit more about European equities. Now, coming up, Prada buys Versace for nearly $1.4 billion. We get the latest on the luxury deal and the market reaction. That's next, and this is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
With investors on edge as tariff headlines spark volatility across global markets, Bloomberg Surveillance has the insight and commentary to give you a jump start on the trading week. Tune in for special coverage this Sunday starting at 6 p.m. Eastern. Context changes everything.
The The conversations that matter, the insights you need. This is the pulse, and I'm Francine Lacqua here in London. Now, Prada has agreed to buy Versace for nearly $1.4 billion in cash, strengthening its position as Italy's largest fashion group. Now, to discuss Prada's largest ever purchase, we're joined by Bloomberg opinion columnist Andrea Felsted with Goldman's Christian Muller-Gleesman, who's still with us. But first, let's go to Milan and bring in our South Europe Bureau Chief, Tommaso Ebhardt, who I know was instrumental to understanding and breaking the story. Tommaso, thank you for joining us. So why is, I mean, this is, you know, we're talking about Versace. It's not a natural fit. Why is Prada buying Versace?
Ciao Francine, buongiorno. Is buying Versace just because it's not a natural fit, just because it's the polar opposite in terms of style and design. So Prada considers this a very complementary brand during the fashion cycle. You know, an analyst wrote when minimalist meets maximalist. So the idea is to bring a brand which is completely different than Prada and Miu Miu itself, and also to become bigger, to better compete with a global giant like LVMH and Kering. And remember that, you know, Prada's chairman, Patrizio Bertelli, has always wanted to create a sort of Italian conglomerate to compete with the French rivals. It didn't pay off 25 years ago when he first attempt essentially ended up with a lot of debt, and Prada somehow being helped by Italian banks to survive. Now, with his son Lorenzo, it's a new chapter, and this probably is part also of a succession plan in the company.
Tommaso, I mean, you know Prada intimately also thanks to the book that you've just written on Prada called Prada by Tommaso Ebhardt. But how much of this acquisition is actually a game changer for Prada? I mean, Prada seems to be at the top of the game. It's doing very well in terms of revenue, especially Miu Miu, the sister brand, is like the fashion thing at the moment, whereas Versace probably needs a bit of love.
Could be a game changer. It's also very risky, as you said. You're buying a brand which really needs a revamp, and Prada has already a lot on its plate. But yet, it's also for them an opportunity. It will kept separated in a separate unit. Lorenzo Bertelli, the heir of the family, who had an important role in acquiring Versace yesterday, made clear that his mother, Miuccia, won't be involved in the creativity of Versace. So for Prada, somehow, it's also the moment to get a bigger management team, be more structured, because you have to handle a new important brand. So it's a risky deal, but also gives size and complementarity to Prada.
Tommaso, thank you so much. Tommy Ebhardt there with the very latest on Prada and Versace. This is what everybody should do on a Friday. Learn Italian, read the book on Prada, and get ready for the weekend. Let's also talk now to Andrea Felsted from Bloomberg Opinion and Christian from Goldman Sachs. Andrea, look, you're a retail fashion expert, and there are a lot of questions on whether this makes sense, whether this is a smart play. I mean, this also comes at a really difficult time because of tariffs.
It does. I think this is a terrible idea. I think, you know, Pradaci should have been left in the design room and not seen the light of day. You know, it is incredibly risky. They're talking about a 2 to 4 year time frame. They haven't overpaid for it when you compare the multiple to recent deals, but they haven't got a bargain either when you consider that it will need a lot of investment, it will need an overhaul. All that is going to happen in a really difficult market.
But is there any talk? I mean, do you keep the two brands completely separate? Because you think of Donatella Versace, you think of Gianni Versace, you frankly think of J-Lo in like skimpy dresses. It's very different from Miuccia Prada.
Exactly, and they think this is going to be, as Thomas said, they think this is going to be a key. When you think of the Versace archive, you know, you can mine the archive and really come out with some, you know, iconic pieces. It's also got a lifestyle offering like homewares and hotels. Still, I think this is, you know, very risky. The fact that Miuccia Prada isn't going to be directly involved in the creativity, I think, is actually a worry, not a strength. So yeah, there's a lot of concerns with this. It
also feels like luxury groups are just getting bigger, right? Because you have Kering and LVMH. And for someone like Burberry, they're struggling because they're on their own. So is it also just a race to get bigger and have more brands? And is that in any shape or form a winning formula?
Well, it has been for LVMH, although even for LVMH, there's talk about, should they spin off some of the divisions. But the thing is, if the bigger you are, the louder you can shout, the more resources you have, the louder you can be to really keep your brands at the top of consumers' minds. And in a difficult time, there does tend to be a flight to those top end, the brands you don't want to take, you're spending a lot of money in a difficult market. You don't want to take a risk on something you don't know. You really want a classic.
And Christian, I guess to the point we were having before is that these tariffs touch industries in different ways, but also it's maybe a little bit too soon to understand because these tariffs are a question mark. Do they get hiked? Do they get taken off? Does it settle? For a lot of industry groups, especially in Europe, it's a bit of a wait and see situation. So it's the strong ones that will do better sector-wise.
Yeah, no, I think you have two problems for sectors right now. You have the cyclical risk, the recession risk we discussed earlier, and you have the profitability risk. If you look in the last few years, the most important style or factor within equities and sectors has been profitability. And now the tariffs, they're starting to weigh on these supply chains, on the whole global trade system, and they introduce these inefficiencies which will weigh on profitability. Luxury goods is a very profitable kind of business. So you got to ask yourself if the tariffs to some extent will change that, and then you have to revisit the equilibrium valuations.
I mean, when you look at your favorite sectors, is tech still in there compared to something, maybe some of the cyclicals that are also more dependent on consumer appetites, be it retail or something else, given inflation could go up?
Yeah, I think, right now it's very difficult. I think we're leaning defensive. We don't think that across assets recession risk is fully priced, which means within the sectors as well, you have to be careful. A lot of repricing has been done. Cyclicals have materially underperformed defensives. But we don't think we're at the point where you can sound clear, so we're more defensive. Tech, as you know, has defensive and cyclical tech. So the problem is the defensive tech has potential headwinds from the tariffs, digital service tax, and then there's the cyclical tech, like SAP, very high quality company, but it's exposed to the corporates, exposed to the business cycle. So we are actually much more focused on defense, low volatility type sectors with a bit of value sprinkled in to diversify valuation risk.
I mean, Europe still looks cheap. Is that for good reason, equity-wise, compared, for example, to certain parts in Asia?
Yeah, I mean, China is very cheap. We know that. And if you look compared to history and other markets, that is very cheap. Europe, I think, is a bit in the middle. I think going into this, Europe actually re-rated quite a bit, led by companies that have gotten bigger in the index that are actually very profitable. But again, if you look at valuations, I don't think Europe is cheap. I think in aggregate, you're looking at valuations that are reflecting slightly better profitability and not reflecting a recession yet.
Andrea, going back to luxury, I guess the consumers in China will, if not freeze up, certainly will have a really tough time. Does that impact luxury?
Yes, it does, but the biggest risk is the US. We know China's sluggish, slow rebound. All of the hope at the end of the last year was that the US consumer would come in and pick up the slack until China was spending. We had roaring equity markets. We had a lot of confidence straight after the election. That really seems to have evaporated.
We've talked before about the fact that a lot of these luxury companies have hacked prices by 20 to 30% during COVID. What does it mean for tariffs? Can they still pass on some of these tariff costs, or do they just need to absorb it?
That means it's much harder to push up those prices. If this had been 5 years ago, we would be far less worried because, luxury groups have pricing power, they're expensive items, they're high margin, but those big price increases have really changed the picture.
Okay, thank you both for joining us. Bloomberg opinion columnist Andrea Felsted and Christian Müller-Gleesman, head of asset allocation research at Goldman Sachs. Now, coming up in a week dominated by escalating global trade tensions, where do traders' concerns over cybersecurity risk sit? We speak with the Okta co-founder and chief executive officer Todd McKinnon. He's coming on next, and this is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, the euro touches a 3-year high as China hits back at the U.S., raising tariffs on imports to 125%. Markets continue their roller coaster ride. The Spanish Prime Minister says China is a partner of the EU as he pushes for a closer relationship during a trip to Beijing. Plus, the UK economy surprises with 0.5% growth in February, the strongest in almost a year. Now, we begin with the latest out of Beijing. China will raise tariffs on all U.S. goods from 84 to 125% with effect from tomorrow. Let's get the details from Bloomberg's Alan Wan in Shanghai. So, Alan, just talk us through exactly what we learned from China. And is this a clear escalation, or is China still trying to retaliate but not going full force?
Yeah, I would say the latter. Overnight, White House clarified that it had increased its tariffs on China to 145%. So, and just now, China said that it's going to increase it to 125, which is 20 points below what the U.S. has been imposing on China. No, I don't necessarily think it's an escalation. And China also said that we're not going to go any higher, which, even though the markets responded negatively, we saw futures start dropping, and I'm sorry, didn't drop, but they paired gains, and the yen strengthened. But I think that some traders were pleased by the fact that China said that it doesn't matter from now on, we're not going to increase it anymore, just because it makes no economic sense. At these levels, people here are not going to be buying many U.S. products.
Okay, Alan, thanks so much. We'll get, of course, stay on top of this story with Alan Wang from Shanghai. Now, EU finance ministers are meeting today in Poland to discuss the latest on tariffs and the European response, as well as finance European defense. Bloomberg's Oliver Crook spoke exclusively to Pascal Donohoe, the Irish finance minister, who said the EU president, Ursula von der Leyen, is calling for a balanced deal between the EU and the U.S.
So a balanced deal from a process point of view is one that we achieve through negotiation, through using the weeks that now lie ahead to engage centrally with President Trump's administration through the Commission of the European Union. Balanced is one that would involve as much of our economies as possible, and to reach an outcome that takes us away from global trade tension, which for all of us would mean fewer jobs, lower growth and higher prices.
So that was the Irish finance minister speaking to our Ollie Crook. Ollie, so how big is the task ahead?
Yeah, it's an absolutely massive task for European finance ministers that are gathered here in Warsaw, and they really have three things that they need to achieve and they need to figure out in this meeting. The first is the question of negotiation. As we've heard from everybody repeatedly for weeks and months, the European sort of ideal outcome here between the United States is a negotiated outcome. So there's a question about what the Europeans are willing to put on the table. We've talked about a 0% to 0% deal with the United States, but of course Donald Trump is calling for the elimination of non-tariff barriers, which is still an extremely abstract idea, which brings us to the second task for them, which is creating an architecture for retaliation. If they cannot make progress with Donald Trump over these 90 days, the suspension of these tariffs, and you know there still are 10% tariffs, and they want to bring all of that down. If they cannot, they need to create an architecture in order to respond to the U.S. administration. This could mean taxes on digital companies within the United States that do business in Europe. This could mean higher regulations for those businesses. It could mean higher tariffs, all of those sorts of things. And the third thing, Francine, is evaluation. They need to evaluate what the impact of all of these measures are going to be on the European economy and trying to figure out how to respond to that. Do they need to treat this like a crisis? Do they need to set up crisis measures to support businesses, to support workers? That is the conversation that is happening here in Poland while we await the outcomes from finance ministers who will be meeting over the next 2 days in what we can only describe as really a very chaotic situation, particularly within the markets.
Ollie, does Europe have to choose between Trump and China?
Well, listen, this is an increasing conversation. I mean, as I was interviewing Pascal Donahue, you had Pedro Sanchez standing alongside Xi Jinping speaking in Beijing, and the Spanish have been, for one, a sort of part of the European Union that have called for a closer relationship with China. When I speak to different finance ministers and different policy officials here in Europe, they are very cautious about making that full pivot. That being said, as the conversation continues, as the pressure increases from the United States, this is inevitably going to be a conversation. Have a listen to what Pascal Donahue told me, the president of the Eurogroup, so really sort of trying to corral all the finance ministers in terms of what their position is versus China, but also trading with the rest of the world.
It is imperative that the European Union communicates to the US, but also to trading partners all over the world, the fact that we want to be reliable and predictable trading partners. It really is up to President Trump and to the US for them to determine how they want to negotiate, what their priorities are. But the EU is a long-term, stable, predictable trading partner.
So, Francine, not a full pivot to China yet, but the Europeans will definitely be looking at striking new deals with other trading partners around the world. We already have the EU talking to the UAE about a free trade agreement, and it's not just in trade. The EU wants to also be a reliable partner for markets. Could the euro take a larger place as a sort of haven currency of the world? That's all ahead with the conversation we're going to have, notably with the German finance minister in a couple hours.
Ollie, thanks so much. Oliver Crook there in Warsaw. Now, businesses around the world have spent the week worrying about supply chains and unpredictable U.S. trade policy, but cybersecurity and the risks from malicious attacks remain a key concern in the corporate world. Now, we're joined by co-founder and chief executive officer of identity and access management company Okta, Todd McKinnon. Todd, so nice to have you on the show again. Now, you're really targeting AI companies as customers. So what's their concern with security right now?
Well, thank you for having me, Francine. It's nice to be here. Companies are thinking about the next platform. So when we think about AI, we talk about AI agents, but really we're talking about how do companies build the next platform for software development. So in the future, all software is going to be AI agents and have an AI component. So we're defining the next platform. So it's like we're building the next iOS or the next Microsoft Windows or the next Linux. And that platform has to have great applications and has to have great capabilities, but it also has to have really robust protection against attacks. And what Okta's doing on that platform is we're trying to bring the identity piece of it. So we released this week something called Auth for Gen AI. So these companies that are building these applications, these AI agents, can have great identity and secure identity and identity that can connect to multiple systems and identity that can broker the connection between agents and people and have that done in a secure way and have the outcomes that they want to accomplish.
So, Todd, I mean, does 80% of the world actually, I guess, not understand how difficult this is, given AI, where you can fake personalities or even, fake maybe facial recognition longer down the road? Are people taking this seriously enough? At the end of that, I mean, this is why your company is worth $15 billion, because some people are taking it very seriously, but is the wider public aware of the dangers?
Well, I think what's becoming more and more apparent to everyone is that cybersecurity is important, and as part of that, identity management is at the core of that. Whether it used to be about network firewalls and what you did on your personal computer to be secure. Now for a company to be secure, they have to manage their identity. So they have to know who the people are in their organization, who their business partners are, who their customers are, who their employees are, have a system to securely identify them in a robust way. And that all translate to this new software development platform of AI agents. The same things apply. You have to know who are the people, who are the agents. You have to be able to broker the connections between the two. And that's going to unlock the value of this new AI revolution.
How quickly will we have such a platform?
Well, there's pieces of it already today. And you're seeing companies like Salesforce launch their version of the platform. Google had a bunch of announcements around their version of the platform this week. And we're doing our part with Auth for Gen AI. So as an industry, we're busy building it. And we're trying to deliver value to customers today. And at the same time, balance the long-term risks to make sure the platform is used in the most positive ways and we avoid all the cyber issues that are possible.
Todd, what are you most excited about when it comes to AI? Because I know you've pushed back, for example, about this, belief amongst many that you'll lose jobs because of AI, or certainly there'll be such a huge disruption in the jobs that humans will do because of AI.
I believe that there's going to be some change and some transition, but I think a lot of the industries where AI is being used the most heavily, I think the talk about losing jobs is a little bit overdone. Mm-hmm. Take software development, for example, something I know a lot about growing up as a software engineer, and people talk about how AI is going to replace software developers. I think that's very overblown. I think what you're going to see is every generation of technology, from computers to PCs to mobile phones, the software development tools got better. And that's no exception today. The software development tools are getting much, much better. But what that's done is it hasn't resulted in fewer software engineers. It's resulted in the software engineers working on bigger problems and more important problems and letting the machines do some of the low-level heavy lifting that wasn't really required of a human. So I think you'll see that in a lot of industries. AI will help, and the people will do other tasks that are more valuable.
How much do you want to grow Okta by in terms of revenue, or just is there acquisitions on the table, or will it all be organic?
We're excited about the future. We think the market we're playing in is an $80 billion market, and our turnover last year, US dollars, was $2.6 billion. So we have a lot of room to grow. And the good news is that our core market is quite large and robust. And then also it gives us a good opportunity to look to adjacent markets as we try to solve these problems for our customers.
So, Don, after basically launching these new tools to secure AI and digital identities, what's next in what you're trying to develop? And how quickly will it be accessible?
Yeah, our strategy is we want to have the leading product in every subcategory of identity. So we've launched over the last couple of years products in things like privileged access management, or identity threat protection, or identity security posture management, customer identity. So it's really, we want to continue our lead. We're by far the largest independent and neutral identity company. We want to extend our lead by having the widest breadth of identity products in the industry, but also have the deepest integrations. Identity systems are only as valuable as how connected they are to everything in your ecosystem, so that's our strategy.
Todd, thank you so much. That was a great conversation that I hope will continue, because this is something that a lot of people, and we have viewers writing in, want to know more about. Okta co-founder and chief executive officer there, Todd McKinnon. Now, Donald Trump's flip-flopping on tariffs has sparked major swings across markets, from losses in U.S. stocks to rounds in debt, FX, and commodities. Ray Dalio, founder of Bridgewater Associates, is warning that investors are too focused on tariffs and not paying enough attention to the breakdown of major monetary, political, and geopolitical orders.
There has to be a recognition that we have a structural problem in that we have an interdependency that the United States can't, either financially or geopolitically because of the risks, be in a position where it's dependent on getting stuff from China. And similarly, for the Chinese, they can't feel safe about getting their capital returns in that way. So in a global economy, you can't have, by definition, large imbalances. So now the question is how to deal with that. That's an engineering exercise. In my opinion, they can have a negotiated way in which the currency is raised. They have to, in one way or another, deal with this, reduce that, So the currency can be raised, or RMB, which would happen by then starting to sell off reserves. The United States likes the fact that the currency would appreciate, and that probably the Chinese like the fact that they can get less in debt by selling off some of their holdings in that dynamic to support the currency. In which case, then China has to not just be a manufacturer, but it has to be a consumer. And right now, about 33% of all manufacturing in the world, which is more than the United States, Germany, and Japan combined, is from China. So they manufacture. The United States does not manufacture that. And so what the world needs now is the Chinese to be consumers. So if you were to have that foreign exchange increase and you were to deal with trade together in a sensible way, I think, ideally, then you would also have naturally Chinese doing an increase in monetary and fiscal policies to raise demand, particularly consumption, because exports are going to go down, manufacturing is going to be a problem, so that if they raise consumption and the United States becomes less consumption driven and more production driven, at least those are movements in the right direction. Such negotiations, unfortunately, and such actual big changes are unlikely to take place quickly enough and well enough, is my fear.
But, Ray, I mean, given that, and given this possible permanent scarring of U.S. dollar and treasuries, is a U.S. recession actually avoidable?
I think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero, you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable. But who cares about, let's say 2 quarters of stagnation or a little bit of negative? I'm more worried about the greater dynamic of these conflicts. I'm worried about more serious issues.
Ray Dalio there, the founder of Bridgewater Associates. Coming up, banks kick off earnings season with JP Morgan, Morgan Stanley, and Wells Fargo reporting today. So we'll have a full preview. That's next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, JP Morgan, Morgan Stanley kick off earnings season today as banks and other major companies struggle to navigate Donald Trump's trade war. Now, Bloomberg's Charlie Wells is here with the very latest. Charlie, good morning. I mean, everyone's struggling, A, to understand, 2, to actually count some of their losses. Now, on the banking side, will analysts be paying attention to anything than the forward guidance?
Francine, I mean, that just kind of hits the nail on the head, right? This is all about the future, and that's going to be really frustrating for particularly traders who actually had a pretty darn good quarter, right? It's looking like record revenue for some traders, Morgan Stanley, JP Morgan as well, really having some strong equities trading there. But there's a really interesting question here about equities trading and just trading in general. There's been a lot of volatility. Have we reached peak trading, right? Because if there's too much volatility in these markets and it's looking like the volatility will continue, participants start sitting on the sidelines. So that's kind of looking back. But yes, the question is, how do these banks even project forward what's going to happen in the year ahead?
Yes, so bigger picture, how are banks and other large firms really navigating, again, earnings amid so much uncertainty and so much market volatility?
Yeah, I mean, I feel really bad for the junior analysts at these firms who have to come up with these slide decks and these investor presentations and these earnings calls because they've been ripped up time and again as policy changes. And I think, one of the dilemmas that CEOs face right now is, do they give a lot of information and then have to worry about being wrong or having to backtrack, or do they give too little and then analysts who have to come up with their assumptions anyways, do those analysts come up with some kind of estimation that's not right? So I think there's this real difficult balancing act that they face, and it's the subject of our big take today.
Charlie, thanks so much. Charlie Wells there with the very latest, of course, on some of the banking report. I mean, it's kind of, fly. I mean, usually the JP Morgan report is like 110 pages and we have to go through it. And even more with the added volatility is going to be an incredible couple of hours. Now, let's continue our coverage on how the banking sector is interpreting the impact of Trump's tariffs. Our Bloomberg opinion columnist, Paul Davies, joins us now. So Paul focuses on banking. And Paul, you've written good morning, first of all, but you've written some great columns kind of, encapsulating why some of the financial stocks have been under pressure, as much or not more than a lot of the other industries. So your first column, when all this turmoil started, really hit for me the nail on the head. It's basically Trump's trade war looks brutal for finance too. So this is my morning must read. I know you've done a couple of other ones afterwards, but it basically has all the ugly sides, all condensed if you're a bank, because you have loans you have to deal with, you have consumers, you have retail banks.
Yeah, exactly. So, I mean, the problem here is the stagflationary outcome, is the high inflation or, persistent inflation and low growth. And what do you do then? It's, either rates stay high and you end up with a lot more credit problems, a lot more bad loans, or rates are cut and you probably still get bad loans, but you also get lower, interest income. And then at the same time, I mean, as Charlie was saying, there's been some great equities trading in the first quarter, but that might well fade from now on because, there's so much uncertainty about exactly what to do. People have got into more defensive positions and they'll probably stay there. And on the investment banking, the fees side, everything is just on hold until there's some certainty. So we've already seen, StubHub, Klarna, eToro pause, IPOs that were due to come basically about now. Nobody is going to take the dust sheets off those things until you get much more certainty about where markets are going.
But Paul, who do you think, first of all, suffers the most? Again, I know, apart from the companies that can't IPO right now, there must be banks that are especially vulnerable. Given there was a point where the market was so distressed that we kind of thought whether some investors would even go under. We hadn't seen any of that, but that was one of the questions that people were asking.
Yeah, and I mean, the thing that really turned White House policy this week was the sell-off in the bond markets. And if that, I was talking to lots of people yesterday involved in kind of funding and repo financing and so on. And the message was, well, everything was functional. It was strained, but it was functional. There weren't like real problems yet, but if they hadn't have, if Trump hadn't have pulled back on some of those tariffs and that trading had continued, then you would have seen much bigger funding strains and real problems in the shadow banking, the hedge fund sector, and possibly the Fed having to step in and do something in terms of supporting Treasury markets.
Yeah, so what are you looking out for in the earnings today? Again, this is partly like, consumers will be slammed because of lower growth and higher inflation.
Yeah.
If you're a commercial borrower right now, you're also probably looking at your books.
Yeah. I mean, there's like a lot of, in terms of, just like capital markets, in terms of investment spending, in terms of order books, people are just kind of going to be sitting on their hands a bit and not doing, so much business. I mean, it was interesting. Jamie Dimon was on TV on Wednesday and talking about how he saw recession as a likely outcome under those, global tariffs as they were. So we'll be listening today to hear if he changes his tune on that. I mean, we still have, blanket 10% tariffs across the world, 25% on cars, whatever the number is on China now. It's still not a great world to be in. So does he still think we're looking at recession, or has his view kind of eased off a bit?
Look, investment bank was meant to be, 2025 was meant to be the big year of revival for the investment bankers. Are we going to see job losses?
I mean, if this carries on as it is, then almost certainly. The first quarter has already disappointed in terms of, M&A, IPOs, and that sort of thing. We had a great finish to 2024. Everybody thought that, a pro-growth, deregulatory, Trump administration was going to just, set fire to all of this stuff, and we'd have a great boom. First quarter was already disappointed because there was so much uncertainty. That uncertainty's only grown, and its second quarter is going to be really disappointing unless something changes, and then on into the rest of the year.
Paul, I'm going to go rogue because I do quite like you did a couple of explainers on Instagram on things that were quite nerdy, like the spirals and some of the carry trades. Also, I think in some of the bonds. Like, what did you live through in the last 7 days? Like, is there anything in the financial system plumbing that we should be looking out for compared to past crises?
I mean, again, I'd go back to the Treasury bond market and the financing and the hedge fund world. This week has been you've seen some kind of quite wild sell-offs or wild-looking sell-offs in Treasuries, but it has been relatively orderly. We haven't seen prices really gapping. We haven't seen people struggling to kind of like get orders filled, and it's when that sort of thing starts to happen, that's when you're really into like proper crisis mode.
Yeah, on the hedge funds, and I had a conversation yesterday with Ray Dalio about maybe, some of the proposals by the Brookings Institute to curtail some of the hedge funds if these market dislocations are much more violent. Is anyone going to look at more regulation because of what happened this week and last week?
I mean, my personal view is that ultimately they have to, and that's because this whole complex of very, very large hedge funds is now so important, not just to the financial system, but to the financing of the broader economy. I wrote a long piece about all of this this week as well. And I think ultimately, a simple leverage ratio where you just cap how much money they can borrow is too simplistic and too crude. It's like a leverage ratio for banks. So what you need is that combined with a more risk-sensitive leverage ratio and some measures of how much liquidity they have to hand to defend themselves against waves of margin calls and that sort of thing.
Okay, thank you so much, Bloomberg opinion columnist Paul Davies. Now, don't miss our exclusive interview with the Swiss President and Finance Minister, Karin Keller-Sutter. That's at 11:45 a.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. China fights back. The country ups its tariffs on U.S. goods to 125%, saying the U.S. should bear responsibility for the market turmoil. Sell America. An ominous drop in U.S. risk assets alongside the dollar and treasuries grips markets. And the first read from corporate America. The banks kick off earnings season with guidance amid the volatility in focus. Well, wow, that was a week. It's not even over yet. It's a week that's felt like a year, and a year that's already felt like a decade. And Sell America continues with some pace. Look at what the euro is doing this morning. Stronger by nearly 2%. That's after the euro already gained 2.3% versus the dollar yesterday, the most since 2015. Meanwhile, the 30-year yield, little change. You do have some buying this morning, down by a basis point for both your 10s and 30s. We stand at 4.4%, 4.85 for the 30-year yield. 30-year yields yesterday, seeing their biggest jump for the week if we continue at the level that it was since the 1980s, adding 13 basis points yesterday. An ominous dynamic that you're seeing, that you're more likely to see in emerging markets, not in the world's deepest and most liquid markets. Now to equities, into the red this morning after China announced that 125% tariff on U.S. equities. We have remarkably seen 5 days in a row with an intraday range of more than 6% for the S&P 500. Deutsche Bank pointing out that the only other times you've seen runs that match that is the great financial crisis in March 2020. By the way, even though we are selling off this morning, if you were to look at equities for the week, we are on track for the best week since the November election. Kind of covers up some of the craziness that we've had underneath the surface. Speaking of the craziness underneath the surface, let's get you some stocks to watch in what's already a strange session. Here with that is Bloomberg's Joe Easton. Joe.
Morning, Danny. So Tesla leading the Mag 7 lower today following those headlines around China ramping up tariffs on the US to 125%. We can see Tesla down 1.6% at the moment, set to be down almost 40% for the year today at the open of trading in the US. And those same headlines on China also hitting Chinese companies with the ADRs listing in New York. We have seen Alibaba trimming its gain in the last few moments. That stock was up around 4% earlier, coming back down given those trade war worries. And then back to the banks, JP Morgan and Morgan Stanley, two of the names out today. All the focus on this volatility boosting the trading desk for equities businesses, but potentially the headlines around the impact of the tariffs going to be the main focus on the earnings call. Keep an eye on these stocks, which are slightly higher in the pre-market. And all of these moves, as usual, are wrapped up in our Before the Bell opening wrap which is available on the terminal right now.
Yeah, those analyst calls from the banks must listen to. Joe, thank you so much. Bloomberg's Joe Easton. Now, we have a great hour coming up for you. We're going to be speaking with Mark Haefele of UBS Asset Management, and later in the hour, Kayla Cedar of State Street. But first, back to our top story. 125% tariffs on all U.S. goods. That is the cap, according to China, as it pushes back. Just in the last hour, it is a response to the U.S. raising levies on Chinese goods to 145%. Team coverage starts right now. Joining us is Bloomberg's Balazs Pens in Hong Kong, Kevin Whitelaw in Brussels, and Oliver Crook in Warsaw. Balazs, let me start with you. What did we hear from China just moments ago?
Well, I think it's a very strong message, and the message is that any hopes of a trade deal between the U.S. and China, or even hopes of a negotiation between Presidents Trump and Xi, have diminished even further. They had been already very dim. And what makes that crystal clear is the language that China used in the statement after the announcement. They said any further increases in U.S. tariffs is meaningless. They called the tariffs a joke. They called it a bullying tactic. And in the meantime, look at what they're doing. Diplomacy is ramping up. Spanish Prime Minister Pedro Sanchez is in Beijing right now. President Xi is planning a trip to Southeast Asia. The U.S. leaders will visit China in July. So it's almost like China is telling the U.S., we're moving on without you, with the rest of the world.
Kevin, let me bring that to you. China saying that it's now going to ignore any further moves from the White House. Is there any room for negotiation? Does the Trump put still exist with markets, again, in meltdown mode?
You know, I think everyone's trying to understand exactly where the U.S. is. And the problem is, you know, no one really knows who they can negotiate with, who can cut a deal, and what the U.S. is actually looking for. So whether it's Europe, whether it's Japan, whether it's Vietnam, or certainly whether it's China, their first challenge is just getting people to answer their phone calls. And then their second challenge is trying to figure out, can any of them actually speak for Donald Trump? And so far, the answer really has been not really. And so ultimately, it's going to be a question of who can get into the room with Donald Trump and what is he actually looking for. The EU can't entirely figure it out. Japan can't figure it out. And it's very clear China can't either. It's not really clear to anyone whether Trump knows what he's looking for at this point, given the number of different ways he has talked about what this tariff strategy is actually all about.
Well, we have heard some clarity from Scott Bessent, whether or not the president's listening to him at this very moment. But yesterday, Oliver, Scott Bessent saying that the U.S. could approach China as a group with allies. You're there at the finance ministers' meeting. Is there any appetite to work together with the U.S. against China?
I mean, I think there is great appetite to work with the U.S., but again, as Kevin is highlighting, it's very difficult to cut through for the Europeans right now. And for finance ministers assembled here in Warsaw, there's a massive task ahead. There's really three parts. There's a part of basically negotiation, retaliation, and evaluation. The negotiation part is what we've heard from everybody. They'd like to cut a deal with the United States. The question is, what can they bring, these sort of phenomenal deals to the United States that would actually cut through? They don't really know at this point. That brings us to retaliation. They're also here to create an architecture of response to the United States. That could involve targeting U.S. tech companies. That could involve taxing them. That could involve a number of different non-tariff barriers, including more tariffs against the United States. And then evaluation, Danny. They need to figure out how this is going to hit the European economy. Every finance minister I've spoken to at this point has basically no idea other than it's going to be very, very bad for the European economy. It's very hard for them to get their arms around how this is going to impact the European economy and how do they respond to that? How do they cushion that for companies and for workers? And Danny, we know that Donald Trump wants to reorder the total global trading system, the global system more broadly, but is part of his plan to have everybody move a little bit closer to China, to open up trade among other countries? Probably not. And is it certainly his ambition to basically move the markets away from U.S. haven assets into the European assets? I mean, Danny, I was just looking at the chart. Yesterday, we opened the session on the euro at 109. We've broken through 114 today. This is absolutely huge in terms of the moves, and these are the conversations I'll be having with the finance ministers here. Is Europe, is the boon to the new treasury?
That dollar move spooking a lot of people, especially because it's coming in tandem with Treasury, something that we've seen, for example, in the financial crisis, in LTCM. Laz, if I can go back to you, I just want to reread the statement that we got from the Chinese this morning. Given that American goods are no longer marketable in China under the current tariff rates, if the U.S. further raises tariffs on Chinese exports, China will disregard such measures. Basically saying it's already so high that pushing tariff rates even higher won't make an impact. Just what level of decoupling are we already witnessing with rates given where they are, Balazs?
It's quite stunning, isn't it? It's a $700 billion trade relationship, and the Chinese messages that they see it as severed, basically. That's the only way to put it. However, let me just highlight, beyond the goods trade, there's also the services trade, which is something China seems to be thinking about more and more. We're thinking about things like travel, education, financial services, computing services, entertainment, and that's where the U.S. actually has a surplus with China, and that's where China can make the U.S. feel a little bit of pain. They already said they will limit the access of U.S. movies to the Chinese market, obviously a huge market for Hollywood. So that's one area where they might even be able to go further, even after saying they will not raise tariffs on goods.
And what is the threshold of pressure? Kevin, I come back to this with you because when we had the last Trump pivot, you can use whatever explanation you want. The bond market and volatility, JP Morgan's diamond on Fox Business, Congress getting a bunch of complaints, or Trump just saying he's feeling the vibes and changing his mind. How do we understand what might move the White House and what pressure he's maybe getting from those he's working around right now?
I mean, I do think it's very clear the bond market was a huge driver of that pause. I think that, look, Donald Trump has always measured his success to some degree on where the stock market is. I think some of his advisors have been able to try to get him to stop worrying about the stock market, but I think that everyone was genuinely freaked out about what was happening more broadly. And there are some enormous potential implications for the economy. But so far, he is still listening to voices like Peter Navarro that are in the White House telling him, go, go, go on this strategy. And then at some point, it's going to be a question of whether the other outside voices are able to break through in ways that are going to get, change his mind about what the potential damage is, what the potential risk is. And I think ultimately where that's going to play out is prices. And he ran on the whole pledge. We're going to bring prices down. I'm going to bring prices down. I'm going to bring prices down. And obviously, this tariff thing is going to make things very expensive or create shortages and disruptions that are going to ripple throughout the U.S. economy, and particularly when it comes to goods from China, very quickly now.
Yeah, I mean, it's almost at the point, Kevin, where it's maybe we shouldn't be talking about the pass-through rate, but just whether or not goods from China will even be coming into the U.S. Balazs, Kevin, Oliver, thank you so much for joining us this morning. Really fantastic work. Again, a story that's quickly changing, and it's only 5:10 a.m. Eastern here in New York. Let's get you some other stories that are trending on the terminal this morning. The UK economy has posted the strongest growth in almost a year. Factories ramped up production ahead of U.S. tariffs. There was a shock 2.2% surge in manufacturing production. UK exports to the U.S. has now hit the highest level since late 2022. The House of Representatives passed a plan to advance President Trump's agenda to cut taxes and raise the debt limit. But conservative hardliners say that they want a final package to trim $2 trillion in spending over the next decade. ByteDance's revenue increased 29% to $155 billion in 2024, driven by TikTok's global expansion. TikTok's fate, though, still remains uncertain in the U.S. Last week, the Trump administration granted a second 75-day extension to work out a deal to split from its Chinese owner. For some reason, TikTok being the only thing that Trump is not doubling down on, like he is tariffs. All right, we're going to cover more and these markets as a dollar sell-off continues. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
You're watching Bloomberg Brief on this Friday. I'm Danny Berger in New York. Let's track the moves so far this week because they have been dizzying. The 30-year yields have climbed about 46 basis points. That puts it on track for the biggest weekly climb since 1987. At the same time, the Bloomberg dollar spot has fallen more than 2%, with the team at Evercore pointing out that this is a dynamic that we usually see in emerging markets, and that the world's reserve currency almost always appreciates amid stress. This time, it's not happening. Joining us now is Mark Hayfley, CIO at UBS Global Wealth Management. Mark, Evercore also pointing out that to this magnitude, it's only happened 4 other times in history, to the like of LTCM, the great financial crisis. What do you make of the dynamic and what's behind the dynamic?
Well, look, coming to you from the safety and stability of Switzerland, we're very aware of what we're seeing with the dollar. But I also think the analysis you just pointed to is instructive because you're talking about very serious, kind of beyond recession events. And I think one of the things we did learn this week is that the administration and the Fed, you know, they are watching the Treasury yields, and they have taken some steps to you know, avoid the worst fat tail outcomes of kind of like a global financial crisis. So that's why into something which could turn out to be a recession, we are looking at U.S. equities here, noting that into this volatility and the drawdowns that we've had, history says the performance from here should be quite strong over the next 12 months.
Mark, maybe one of the good things about you being in Switzerland is I think a lot of Americans are going to be canceling their vacations to Europe when they look at what the exchange rate is doing. So maybe you'll have more quiet streets there. You said that usually after episodes like this, you can buy U.S. risk assets. But does the behavior of what we're seeing coupled with policy uncertainty, policy volatility coming out of the Trump administration suggest that maybe we're moving to something that looks like peak U.S. asset ownership?
That is something that we're debating every day. And certainly we're in a period where there is some repatriation of assets home, be that to Switzerland or Japan or elsewhere. I just don't think that all of that can reverse that quickly. I do think that there's still, you know, while we've taken off some of the downside scenarios, there's also the upside scenarios where some of the theories about, you know, achieving deals and refocusing on U.S. growth, you know, those things can also transpire as well. So we're really hitting it, I think, this morning after this latest round with China at kind of maximum, hopefully maximum fear, but certainly, you know, measured on history, very high fear if you look at the VIX and the futures trading down again. So taking that step back usually matters. It could be very different this time, but again, if you dollar cost average it in this period, there will be some resolution probably before the 2026 election.
Mark, you point out a fair point that this is a market with two-way risk right now. It's not just the downside risk, especially we've seen a back and forth. Again, I pointed this out. If you just look at the close of yesterday, stocks are on track for their best week since the November election, which you wouldn't realize looking at just what markets are doing today. But this idea that we will reach agreements, that this is kind of as bad as it gets for U.S. policy with China. Do you have an understanding of what the circuit breaker is for the Trump administration? Do you look to the bond market? Do you look to the comments coming from banks when they're about to report earnings and what Jamie Dimon might say that catches President Trump's attention? How do you understand when that off-ramp kicks in?
I'm not sure, anybody who says they know is probably wrong, given some of the commentary from the president about how he even made the decisions about the pause. But, the sum of all those factors and a little bit the idea that, they've kind of punched themselves out now on the tariffs between China and the U.S., that also creates potentially another opportunity. Again, it is really high uncertainty, and we are talking to clients about other things that can get you diversified away from this. For example, I think all this uncertainty will continue to put a bid under gold. We saw the Chinese central bank continue to make their gold purchases. So, yes, take a look at what the numbers say on equities, but also continue to diversify to have the capital if we get more towards a recessionary scenario and the markets continue to fall in this uncertainty.
If we get towards that recessionary scenario, Mark, are treasuries still a haven? We're already running really big deficits in the U.S., and usually you add even more weight to that in the case of a recession. Do treasuries act differently this time around if we head towards a downturn?
Not on the shorter end. We still believe, they have been a great hedge, and we've been consistent in saying, look to the high quality bonds in the 0 to 5 year. 5 years kind of a sweet spot here, and that's likely to continue to work. I think there's of course the currency factor, and that's something that investors are going to have to consider. But that is I believe the shorter end will still be a go-to safe haven, because at some point, if all these things happen, the Fed will step in, and the market is pricing Fed rate cuts this year.
At what level do you think the Fed does step in? How bad does the dysfunction in markets, I should say, or the economy itself need to get before you see a Fed that's willing to act? Because so far the Fed speak has been one of wait and see.
Yes, well, we've been looking at this closely. I think that around the rate cuts itself, the negotiating tactics that the president has taken and the risk of inflation does make things difficult for the Fed to act immediately, say, on rate cuts. But I think when you start seeing spreads on high yield blow out and things, then the Fed can start taking liquidity measures, and even just they'll start with jawboning that they're very concerned or that they're watching things. So we haven't gotten to that point yet, but I think that we may have had the president not put the pause on.
Mark, really great to speak with you this morning. I hope for your sake and all of our sake that we get a break this weekend. I have a feeling we won't, but best of luck to you. Enjoy the rest of your Friday. Mark Haefele at UBS Global Wealth Management. Coming up, we're going to take a look at what else is making headlines around the world, including some sports for you. One of the world's best soccer players suing his former club over wages. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news. First up on the Wall Street Journal, the Supreme Court ordering the Trump administration to take steps to return a migrant who is mistakenly sent to a Salvadorian prison. The government had argued that it didn't have to do anything to remedy its error. Next up on the FT, Kylian Mbappe, the French soccer superstar, is suing his former team, Paris Saint-Germain, over 55 million euros in unpaid wages. The dispute stems from Mbappe's move to Spain's Real Madrid. And on the New York Times, the tragic sight-seeing helicopter crashing into the New York Hudson's River, which killed all 6 people on board. The crash involved the chief executive for rail infrastructure of Siemens, his wife, and 3 children. A really, really tragic incident. Our thoughts go out to all the families involved. Okay, coming up, we get back to these markets. We're going to be speaking with State Street's Kayla Cedar on how to navigate a constantly changing market. This is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative for us as a business.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. China fights back. The country ups its tariff on U.S. goods to 125%, saying the U.S. should bear responsibility to the market turmoil. Sell America, an ominous drop in U.S. risk assets along the dollar and treasuries grips markets. And the first read from corporate America. The banks kick off earnings season with guidance amid the volatility in focus. And man, it has been some volatility, a week that's felt like a year that's felt like a decade. And the Sell America narrative continues with some pace, at least for the dollar. Look at what the euro is doing. It's off the highs of the morning, but it's still stronger by 1.7% versus the dollar. We're just below 114. It had its strongest day versus the dollar yesterday since 2015. U.S. 10-year yields and 30-year yields drop about 1 basis point for both of them. That's going to provide some relief after the stunning move we've seen higher on the long end this week, 46 basis points. It is the biggest gain since the 1980s, adding 13 basis points yesterday. And to equities, excuse me, they fall into the red this morning. They had been gaining in the pre-market session before that China announcement. But here's the weird thing. If you were to look at a closing basis, we're on track for being higher on the week and the best week since November of the election. Deutsche Bank, though, pointing out we've had a remarkable 5 straight days of intraday ranges of more than 6%. The only time we've seen runs like that was in the great financial crisis in March of 2020. So I mentioned the yield climb and the dollar fall. So far this week, 30-year yields have climbed about 46 basis points. That puts it on track for the biggest weekly climb since 1987. At the same time, the Bloomberg dollar spot has fallen more than 2.5%, its worst week since November 2022. The team at Evercore pointing out that it's a dynamic you usually see in emerging markets and that the world's reserve currency almost always appreciates amid stress. This time, it is not happening. I'm pleased to say that joining us now is Kayla Cedar, macro multi-asset strategist at State Street. Kayla, thank you so much for coming in. A crazy week. I'm sure it's been hard to get time off of your desk. What do you make of this dynamic? What's behind both a dollar weakening and Treasury selling off at the same time?
It's really interesting and really rare, especially because we haven't seen that dollar smile play out as much as we would expect. But, you know, I think there's a couple things to keep in mind here. When we look at what real money investors are doing, so those longer term horizon investors, we do see some demand for fixed income. This is coming from, you know, below average positioning. And so there is room for upside there. But I think you have to ask, okay, where along the curve do you want to be? We have seen long end yields really rise. And so, you know, we have seen consistent demand on the front end of the curve. Now, one thing I think that's also interesting to keep in mind here is when we think about cash and what is cash doing here, positioning there is around average. And so when you pair that with above average positioning in more riskier assets like equities, you know, equities are still above average positioning, so above average exposure there. There could be more room to add to cash allocation in the short term as we ride out this volatility, because as we've seen, you know, the market can change a lot in just 5 minutes.
I'm assuming you're mostly talking about domestic investors, because I wonder what happens to the attractiveness of treasuries for international investors if you don't have what usually is a dynamic that even if treasuries are weakening, you have a stronger dollar.
Yeah, you know, that's such a good point. When we do look at foreign demand for U.S. assets and U.S. treasuries, that's actually decreased a little bit in our data set. Now, you know, something else we're closely watching are the auctions. And the auctions we got this week, you know, the 3-year was relatively weak, but 10-year, 30-year, those, you know, longer end of the curve, the indirect demand and some signs of foreign demand looks still robust there. So there is some signs of, we do see demand there as well.
So the demand is there. The price action is maybe a little bit scary. At what point do you start to get concerned that this is something that looks like peak U.S. dollar asset ownership? And how far away are we from that moment?
That's a great question. I think one thing to keep in mind is one thing we're able to do is we look at risk activity across all asset classes, and we create something called a behavioral risk scorecard. And what we see right now is a -6 reading. And to put that into context, the most risk averse institutional investors can be is -22. So a -6 to me says, there is risk off. However, it's not completely extreme. We did see some of this at the beginning of 2024 when we weren't getting as many Fed cuts as the market had anticipated and concerns around the Fed having to stay higher for longer. And so what this tells me is that, there's not panic, but there is risk aversion.
How are you thinking about this earnings season and what we might hear from companies? We've already had Delta, we've already had a pre-warning from Walmart. Some keep their guidance, some completely remove them. What seems to be the playbook and how investors might react to it?
Yeah, one thing I think that is important to keep in mind is when we look at year-end guidance still looks relatively strong for overall U.S. equities. And when we think about where do we want to be from a regional perspective, U.S. still has really high quality metrics, and I think we'll see that in some of the earnings. Now, there's certainly a lot more uncertainty, and that's really hard for investors to grapple with. But I think what that means in terms of allocation within equity markets is that we want to stay in places that have high quality. And so actually what we've seen over the past week is, healthcare has seen a lot more inflows. And then we've also seen a lot less outflows out of tech. And that's come back more to neutral. And so I think this is a sign that, investors want to be in those higher quality parts of the market to kind of ride out this volatility.
Kayla, does all of this assume that we don't actually see a decoupling with China, that the tariffs don't stay at the current level that they're at? In order for some of these trends to play out, does that need to come off the boil?
We can't anticipate what President Trump is going to do and what is going to happen with the tariffs, but I do think investors have to move their money somewhere. And so places that stand out to me are places like software that are a bit more service driven, a bit less perhaps tariff sensitive. And when we look at, again, on our flow data, and I mentioned, tech flows are starting to improve, that's really in the software space. And so I think, there is a tariffs are in mind as we see allocations shift and adjust. And I don't think the market is necessarily willing to get ahead of this tariff risk. It's a really, as we've seen, volatile, evolving market. So we have to be nimble and be dynamic.
Well, the two-way chop has been remarkable. And look, we were talking about earnings. I thought it was really interesting. Five Below, the discount retailer yesterday, says that it's going to completely halt business with China for now. No more shipments. Any container that has been packed must be unloaded and returned. Completely getting rid of China business. We've been asking the question, what does the pass-through look like? What does inflation look like? What are these retailers going to do? Are they going to pass along the price increase to consumers? Is that the wrong question? Should we almost be asking, will Chinese goods even find their way into America still?
I think that is the right question to ask, because ultimately, who's going to pay for these tariffs? You either see companies having to potentially adjust their supply chains, which is what we saw in 2018, 2019, where supply chains shifted away from China and towards places like Vietnam. And then, who is going to pay for that? Is it the consumer? And so what we see in our data already, because we're able to see inflation from a daily measurement, is in April, we're already seeing above average seasonal upside in inflation, and specifically in some of these household goods areas and some of the retail areas. And so it does look like, whether this is front loading or whether this is, actually feeling tariffs already, we do see signs that companies are looking to pass on prices in some areas.
So as this plays out, what's the haven in this market? What's the haven, especially as treasuries and the dollar look more volatile than a risk-free asset should?
On the equity side, I think there's havens in those high-quality parts of the market, places like software. There are signs that could be some places within healthcare. from an asset allocation perspective, I would be hesitant from unwinding too much equity exposure within fixed income, staying at the front end of the curve, but also keeping in mind cash can still be attractive here. If we see inflation, come back higher, it's going to be harder for the Fed to cut rates. And so what that means is the front end of the curve, like bills versus 2 years, can still stay inverted. And so that's not so bad right now.
Kayla, so great to have you on to end the week in what's been a year of a week.
Yeah, a year of a week.
Kayla, thank you so much. That is Kayla Cedar of State Street. Coming up on the show, another test for stocks comes in just a few hours. JP Morgan, Morgan Stanley, all set to report. We'll have that with Shanali Basak next on your Bloomberg Brief.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Again, there'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing.
President Trump on the cost of transitioning to a new tariff regime, which, by the way, at that point, he was asked by a reporter what he thought of the market moves yesterday, saying he hadn't been looking at them, and asked Scott Bessent to take the question. He spoke to reporters after clarifying that the current tariff rate on China had risen to 145%. And then China pushed back. Barely 2 hours ago, it has announced an 125% tariff on all Chinese goods. Joining me now is Bloomberg government reporter Jonathan Tamari in Washington. Jonathan, just lay it out, the basics of where we stand on China and U.S. tariffs.
Yeah, I mean, we're having a tit for tat, an escalating war between these two countries, these two massive countries with huge numbers of consumers. And even though the President Trump has backed down on tariffs on many countries, China is a different target for him. Politically, I think there's a lot more support for things that are targeted at China. And I think you have a situation here where you have two presidents, President Trump and President Xi, who both place a premium on looking strong before their countries and not wanting to see as losing. And so it's hard to see where the off-ramp is for this particular fight.
On that note, the language from the Chinese coming out this morning, Jonathan, has been pretty remarkable. I just want to read the statement from them. Given that American goods are no longer marketable in China under the current tariff rate, if the U.S. further raises tariffs on Chinese exports, China will disregard such measures. The idea, Jonathan, being that the rates are already so high that the damage can't even get that much more extreme than it is. Are we talking about outright decoupling at this moment of the current rate that tariffs are at?
I mean, that's certainly a threat. The wild card here is that you never know exactly what President Trump is going to do. Even his aides don't necessarily know what he might do from hour to hour. And so that's really the big unpredictable part. So if this goes on for a long time, yeah, you could see a huge break between these two countries. The issue is, again, how do the markets react and how much pain is President Trump willing to absorb? Because even though he's lessened many of his other tariffs, we've still seen economic damage, at least in the first 24 to 36 hours. And so how much is he willing to absorb as he gets to his first 100 days? This is the kind of drop. When you look at polling, his poll numbers are dropping significantly. And it's the kind of thing that could hobble a presidency if it keeps going in this direction.
Well, Bloomberg Economics pointing out that the tariff rate, the effective tariff rate, is now higher than it was when Trump initially announced reciprocal tariffs after the pivot because of China itself. Jonathan, does it look like there is any communication at all between the Chinese and American governments? Is there any dialogue happening that might hint towards any type of negotiation, with Trump yesterday saying that he would hope that they could make a deal?
We haven't seen it so far, which doesn't necessarily mean it isn't happening, but there's not been public indications of it at this point. The administration has said that many countries have reached out, but they haven't provided a list of those people. So I think, that's something that we're still waiting to see. But right now, in public, at least, the public-facing rhetoric is completely hostile.
Jonathan, thank you so much for joining us this morning. I'm sure not the end of your coverage, even for today, even for the next few hours. Jonathan Tamari of Bloomberg Government. By the way, just want to point out, U.S. futures back into the green. What wild swings we have already seen this morning. And could they get more extreme? Because we've got some earnings to get through. J.P. Morgan, Morgan Stanley, Wells Fargo, all kicking off earnings season this morning as banks and other major companies struggle to navigate the trade war. Bloomberg's Shonali Basak has the hardest job today because she has to sort through it all. She joins us now. I mean, Shonali, what in the world might we hear from these banks?
I mean, think about the economic data we've seen. Investors take it as backward-looking information. They're going to listen to what Jamie Dimon has to say today, what Jane Fraser has to say about that path forward, because you're going to have two different things happening. One is you might have incredible revenue from the markets businesses, given the extraordinary volatility that we've seen. Now, how much juice is left in those institutional hedge fund clients after this deleveraging that we've seen? You have to remember, Danny, we came into this year with hedge fund leverage near record highs. So there has been a fair amount of deleveraging. How much more is there to go? Volatility is good until it's gapping, until it keeps investors from getting back into the markets. You're also going to be watching for loan loss provisions. I'm watching the pace of loan growth at JP Morgan to see how much demand there actually is for loans, given that interest rates have remained high.
You mentioned everybody is going to be listening to the commentary, and it was in large part, we understand, Jamie Dimon's commentary on Fox Business that got Trump to do his pivot of sorts. How free do these executives feel in actually commenting on the policy, especially if it's critical comments on the Trump administration's policy?
Obviously, there is a lot of caution, and you see it publicly, you see it privately. For example, we had a story this week about a JP Morgan employee who had a huge public display of this, where he redacted. The name of the report was cold redacted, and there were literal blackouts in the report in fear of making somebody everybody angry. Now, he didn't mention Trump by name, but you could deduce a lot of these policies were out of the Trump administration. He even cited compliance at the end of his webinar, saying that they didn't want anything to appear too one-sided. So there is a lot of balance, but you did see Jamie Dimon be very public in a way that is unusual just a few days before their earnings report to go on Fox Business and lay out just how damaging these tariffs can be. Months after, he said that the tariffs have some purpose to them as well. So this flip-flopping, clearly a level of fear, but not catastrophic amounts, but certainly stifling to the amount of business these banks are doing and their clients are doing.
Right, trying to balance it. But Shonali, we kind of get back to where we started. Do we expect just really wide ranges when it comes to their outlooks for the rest of the year? Are banks under threat, as we saw from Delta, of completely pulling outlooks for the year?
Or the flip-flopping of how they're handling this. Goldman Sachs, the recession call that they drew back right after that 90-day pause is a great example of this. I want to know how that decision was made. Were they ready to press that button the minute they saw any sort of pause, especially given we're still seeing tariffs at an elevated level? And, you know, I think back to a conversation I had, for example, this week with Ann Walsh, the CIO of Guggenheim. She called me in a car ride while we watched. We were on the phone while the 90-day tariff was announced. And she was already trying to look at what existed before the tariffs, what existed after. You saw similarly from Mike Wilson in that regard as well. Is this year going to be as rosy as anybody wanted? Probably not. Right? I mean, you've already seen so much activity stifled, but the question now is how bad it could get.
I was just thinking back to Davos and what these executives were saying then and just how different it is. Well, they were so confident then, and it's completely been the opposite.
Right? It's that Bank of America moment where Trump lashed out at Brian Moynihan that created this fear.
It's such a good point. Shonali, looking forward to your coverage throughout the morning. Bloomberg's Shonali Bassick, Bloomberg Open Interest co-anchor, and tune in for an interview with the Wells Fargo CFO that will happen at 3 p.m. New York time. So this week, the White House made its stance clear. President Trump wants Apple to begin building iPhones in the U.S. But the dream of American-made iPhones faces a reality test. Bloomberg's Tom McKenzie joins us now. Tom, there's been some really interesting reporting about what Apple is trying to do in the face of these tariffs. Things like shipping, 1.5 million iPhones to India. Where does Apple stand in trying to navigate the tariffs?
So they have built out capacity, Danny, in India, and they can use that to some effect. But 90%, on most estimates, about 90% of the iPhone production remains in China for the US. The idea that they can ship all of that over to the US in terms of the manufacturing capabilities, that is just such a tall order. The iPhone, for the context, of course, the iPhone is what drives more than 50% of the sales for Apple. It is the goose that lays the golden egg. But the complexity of the supply chains, the access to labor, the engineering talent, everything that's needed to produce an iPhone, the idea that you can recreate that in the US, for many, is just, frankly, too much of a tall order. You have cities, for example, in Zhengzhou, central China, where you have an area of that city, it's known as iPhone City, and there literally are hundreds of thousands of workers there. But they also have hospitals and schools and all the facilities to support that, dormitories as well. You'd have to think about, for example, a city like Boston, population 500,000, every single person there working on an iPhone supply chain, an iPhone production line. Is that actually what is wanted and what is needed? And then, of course, all the components that go into that, all the engineering talent. So moving that iPhone production to the US is just seems unfeasible at this point. They do produce some, of course, elements and products in the US, including the desktop in Texas. There is a counter to that, which is you can automate. And some in the Trump administration have suggested that Apple could use its cash pile, build out factories in the US and heavily automate iPhone production. But it's so complicated because they develop these on an annual basis, if not sooner than that. And so rewiring those production lines and automating them is something that China hasn't managed to do, and they would like to be able to do that. And the idea that the US could do that with their own components just also seems too much of a stretch. Dan Ives putting out a note. You flagged it this morning as well from Wedbush Securities, saying that ultimately you'll probably see iPhones having to retail for plus above $2,000 US stateside as a result of these tariffs.
Right, and will these companies like Apple be willing to commit more capital in the U.S. as their share price plummets and uncertainty becomes rife? Tom, I just want to quickly touch on Tesla, because the Bloomberg reporter saw that on their website in China, they've removed the order now option.
Yeah.
How far beyond Apple, for some of these EV makers like Tesla, do these supply chain ripples go?
Yeah, now facing those 125% tariffs, or at least they will do from tomorrow, April the 12th, from China, of course. Yeah. So Tesla produces two models in China at that factory just outside of Shanghai, the Model Y and the Model 3. They do not produce the Model S or the Model X, so those have to be imported. Now we're seeing, as you said, that on the website they've removed the Order Now button, so it seems that those are not an option, because how do you price those models with 125% tariffs? This in the context, probably not a huge hit for Tesla in the context. They don't actually sell many of those imported cars, but the volumes have been dropping over 6 straight months in that Chinese market. BYD is a competitive challenge, and now you have the tariffs.
Tom, thank you so much. Bloomberg Daybreak Europe anchor Tom McKenzie. By the way, he mentioned that Dan Ives note. Dan Ives writing that this has created a price shock that will impact the daily lives of U.S. consumers and has ripped the hearts and lungs out of the big tech U.S. supply chain. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get you set up for your trading day on this Friday. Bank earnings kick off. JP Morgan, Wells Fargo, Morgan Stanley before the bell. Some data, PPI numbers for March come out at 8:30. Will you even pay attention to them? And University of Michigan sentiment, that comes out at 10 a.m. A quick look at currency markets. The dollar continues its remarkable and historic weakening. Michael Hartnett over at Bank of America writing that U.S. exceptionalism is turning into U.S. repudiation, and there seems to be a global flee from U.S. assets. All right, that is it for your Bloomberg Brief. Surveillance takes things from here.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Anyone who says they have certainty on where the growth outlook is going, where the tariff picture is going to settle, is probably exaggerating somewhat.
We just don't know yet what the impact will be.
Concern is that you need to see stability in the data. You need to see some level of clarity.
Macro volatility uncertainty will trump the deregulatory positive catalyst.
There's probably less than 3 people in the world that know exactly, what the future looks like.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday as U.S.-China relations sink to a new low.
China has a surplus of $1 trillion. I mean, the numbers are crazy. I don't blame China. I don't blame anybody. I blame the people that were sitting at that desk in that other beautiful Oval Office for allowing it to happen. We'll see what happens with China. We would love to be able to work a deal.
China isn't coming to the table this morning. The Nation raising tariffs on U.S. goods to 125% after U.S. tariffs on China rose to a monster 145%. The policy volatility raising questions about America's safe haven status, investors confronting an ugly combination of higher bond yields and a weaker dollar. Evercore's Krishna Guha writing this: there are only 4 other episodes in the last 30 years in which the dollar depreciated more than 1.5%, with the 30-year bond yield up by more than 10 basis points. The last 24 hours, stocks down, yields up, dollar weaker.
We may look back on the past 2 weeks as the most consequential in modern financial history in terms of a reordering of global affairs, or we may be looking at something that is highly technical that we give a very dramatic narrative to. The difficulty here is how much is what we're seeing a decoupling in financial markets between the rest of the world and the U.S., and how much is things like China selling treasuries, like basis trade unwinds, and like people who don't like uncertainty and are simply boycotting this market.
Very difficult to keep up with what's going on. So if you're just waking up this morning, welcome to the program. We've got some new numbers. 125% tariffs on U.S. goods. 145 is the number that the White House clarified on Chinese goods just yesterday.
So if you're looking at this, you're thinking basically this is U.S. and China decoupling from each other. The Chinese Finance Ministry came out and said, given that American goods are no longer marketable in China under the current tariff rates, if the U.S. further raises tariffs on Chinese exports, China will disregard such measures. So it does feel like this is the top of the tariff rate between both countries. But what is the off-ramp, especially when the Commerce Ministry out of China is throwing in some shade and some hot rhetoric and saying basically it's become a joke?
We need some guidance. Will we get it? Later on this morning, later this hour, we should get numbers from both JP Morgan and Wells Fargo. Later on this morning, Morgan Stanley at 7:30. What kind of guidance can the banks offer us this morning?
Very little. It's going to be really a dark cloud. There are some things that we could learn. Number one, how much are they increasing their provisions for loan losses? That will be very key. How much are they torpedoing the chance of some sort of resurrection of a wave of mergers and acquisitions? Have the deals that have been put on pause been altogether canceled in light of some of the uncertainty? And just how much are they benefiting from the trading regime, especially in an area where we do potentially see deregulation? These are all things they maybe can give us guidance on. What you do with that guidance, good luck.
Futures up this morning by 0.6%. In the FX market, some major moves. Euro dollar in the last two sessions, a 4 percentage point plus move on euro dollar. If we closed here right now for that currency pair, the biggest two-day move on euro dollar going back to March 2009. Euro dollar 113.58. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth, seeing more volatility ahead. The German finance minister joins us as EU leaders meet in Warsaw, and we'll catch up with Jared Cassidy of RBC as big bank earnings kick off later this hour. We begin this hour with US-China trade tensions sinking to a new low. Cameron Dawson of New Edge Wealth writing the following: we continue to think that volatility is here to stay, with the tariff reality creating non-linear risks to growth. Bond market volatility likely keeps equity market volatility heightened. Cameron joins us now for more. Cameron, good to see you.
Good to see you.
It doesn't feel like the best performing week of the year for the S&P 500, does it?
Not at all.
What do you make of this chaos?
Yeah, so we think that there are certainly signs that liquidity is tightening throughout FX and fixed income markets, which just means that it keeps the volatility heightened. If this was Icarus flying close to the sun, the wax certainly started to melt on the wings on Tuesday night when we saw the bond market gap out and yields really spike higher. Now it's spreading into FX markets, which just suggests to us that liquidity is leaving this market, and we cannot rule out that these big moves continue.
Can we just sit on that relationship between bonds and foreign exchange? How unusual is it to see moves of 40 basis points plus on a 30-year yield in a week, and to see the dollar down at the same time by something like 3%?
It's extraordinarily unusual, and it calls into the question why. There was a great article in the Bloomberg this morning talking about how people are thinking that maybe there is Chinese selling, even though there's not a lot of hard evidence for it. The thing we ask is that if you think a big whale, a big owner of an asset is selling, does that mean that you try to get ahead of it and sell before they sell, which just creates this self-fulfilling prophecy of higher volatility and the risk that you have these yields continue to back up even higher.
Well, the reason why people were looking at this in part was also because we had a 10-year and then a 30-year bond auction. A lot of people were saying potentially these would fail. They did the exact opposite. They did really well. There was a record amount of indirect bidders. And then the sell-off continued, which raised questions about whether there were different buyer bases, what's going on. At what point will you see stability enough for you to be a buyer?
Yeah, so eventually when yields get high enough, it draws you in because it allows you to be able to offset some of the price decline. You know, we've been seeing things like in the muni market. The muni market had its worst day in 30 years on Monday, and then it had one of its best days yesterday. So you have all of these flip-flops within the volatility and the price action of markets that we say when we look at munis, we'll step into that, because if you can buy and hold, then certainly you can tolerate some of this volatility. But if you're trying to trade treasuries, good luck.
This has been a week of psychology on every front. You've been traveling around the country, getting a real lesson in psychology on all fronts, I'm sure. How bearish are the clients who you meet with at a time where Michael Hartnett of Bank of America is coming out and saying that right now many investors are talking about 4,000 on the S&P and just have this incredible feeling of negativity?
We're starting to see some of the optimism begin to fray. One of the things that's been the most surprising is just how resilient investor optimism has been through all of this volatility. The buy the dip mentality, we still saw really strong inflows on big down days. Maybe some of that is starting to wane. We can measure it by looking at the AAII equity allocations. It began the year at about 69%. It's at 66% today. At the lows in 2022, it got to about 62%. So people are still pretty all in on equities, which just means that they haven't thrown in the towel. And usually we see equity allocations bottom as the market bottoms, which is one consistent thing.
Do clients think that Trump will step in?
I think that given the moves on Wednesday, was it Wednesday? Given the moves on Wednesday, what you've created this environment is that you have a two-sided risk. You have the risk to the downside that this could all cascade further lower, but then you have the risk to the upside that you can have a 9–10% move in markets just because of one person changing their mind.
So when it comes to what do you do in this environment, are long-term treasuries even a hedge anymore?
It's a very, very interesting question. We think that eventually, if you see growth start to weaken, meaning economic surprises turn significantly lower, that treasuries will be a hedge because you have the flight to safety and don't rule out the Fed with quantitative easing. The challenge is you're probably unlikely to get hard data to weaken as much in order to draw people into this market, and also to get the Fed to move, at least in the next month. We think we're in that Wile E. Coyote kind of environment where hard data is still resilient because you have a pull-forward dynamic of people getting ahead of tariffs. You also have the calm before the storm when it comes to inflation, which just means that the Fed doesn't have reason to act, and you don't have the confirmation of that weaker data to get people to be drawn into the fixed income market.
Let's talk about the calm before the storm. Let's talk about the storm. UBS wrote yesterday, the growth hit is still substantial. It's not priced. What do you think about the prospect of retesting the low on the S&P?
We think the prospects are rising, and Chris Verone at Strategas put out a note saying that 85% of the time you do retest the low. And given the fact that we're not likely to have the Fed step in with a policy action, which was something that was very important to creating the V-shaped bottom in both 2018 and 2020, that just raises the odds of a potential retest. You have to step back and realize that this market's still trading at 19.8 times forward earnings. This is a very fulsome valuation, given the degree of uncertainty and the degree of risk. You haven't really cut earnings estimates that much. 2026 earnings are still at $302 a share, implying 13% growth next year. We think that those numbers are still far too high, which just means that if you put an average multiple on a lower earnings number, you get to a retest.
So think about the phases of the risk aversion we've seen so far. The first phase was just broad-based, very intuitive risk aversion. Equities down, price again, the greater prospect of lower growth and maybe higher inflation in the future. Second phase seemed to be a dash for cash. Starting to see some disorderly moves, some tension. What phase are we entering now? Where are we at the moment? Have we even exited phase two?
Yeah, the weird phase where we're seeing the move in the dollar and fixed income this morning, and yet equity futures are up on that. So I think that we have to be careful not to read too much into one-day moves and extrapolate them into the future, that we continue to see this volatility in these wide bands. And one of the phrases we keep using is a Goethe quote, which is that few people have the imagination for reality. We have to have the imagination for this odd reality that we're living in.
How much do you think that this is a game changer when it comes to international flows into the United States, especially when it comes from Asia, potentially even from Europe?
It's such an important question, and we keep distilling it to something rather simple. If the last 40 years of the economic world order created an environment that was great for U.S. corporate businesses, allowed for operating margins to continue to hit new highs, for capital to be drawn into the U.S., to have U.S. assets outperform, if you completely flip that on its head, do you still have that same kind of dynamic for U.S. outperformance and U.S. capital flowing into the U.S.? You're completely switching around the world order of the last 40 years.
Cam, I hope you get some rest this weekend. Best of luck. Good to see you. As always, thank you. Cameron Dawson there of New Edge Wealth. Equity futures on the S&P at the moment, wild few days. Equity futures at the moment up by 0.5%. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. China will raise tariffs on all U.S. goods from 84% to 125% starting tomorrow. The Ministry of Finance said that it will ignore any further increases announced by Washington because the Trump administration moves have become, quote, a joke. The announcement came a day after Trump increased levies on Chinese goods to 145%. Tesla has stopped taking orders in China for its Model S and Model X vehicles due to escalating trade tensions. The company's Shanghai factory only makes Model 3 and Model Y cars, while the Model S and X, the ones that it's stopping, are imported from the U.S. and subject to increased tariffs. House Republicans narrowly passed a budget outline paving the way for a tax cut package. It would cut taxes by up to $5.3 trillion over a decade and raise the debt ceiling by $5 trillion in exchange for $4 billion in spending cuts. However, conservative hardliners want to trim $2 trillion in spending, which may require curbing social programs. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny later this hour. Up next on the program, China striking back.
We'll see what happens with China. We would love to be able to work a deal. I have great respect for President Xi, and I think that we'll end up working out something that's very good for both countries.
That deal doesn't look close this morning. Up next, The View from Europe. We'll catch up with the German finance minister. Live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
China retaliates this morning, 125% tariffs on U.S. goods. Your equity market, wild week for stocks. On the S&P 500, positive by 0.6%. On the NASDAQ, up by 0.6% on the session so far. The next stop, the banks later this hour, a report from JP Morgan. Turn to the bond market, 2-year, 10-year, 30-year. 30-year yields in the spotlight. A move of more than 40 basis points on the week this morning, 482.53. Lisa mentioned that note from Michael Hartnett at Bank of America. This quote in that note, Musk owned the long end in Q1, but now the long end owns Trump. 482.53 this morning, and that comes even with this move in foreign exchange. Euro dollar, a 2-day move of almost 4%, the biggest 2-day move going back to 2009. Euro dollar this morning, 113.73. Under surveillance this morning, China striking back.
We'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. We're resetting the table. And I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a true sense, he's been a friend of mine for a long period of time. And I think that we'll end up working out something that's very good for both countries.
So here's the latest this morning. China retaliating with 125% tariffs on all U.S. goods after the White House clarified levies on Chinese goods rose to 145%. China's saying it will ignore further increases coming out of Washington. Joining us from Washington right now is Bloomberg's Tyler Kendall. Tyler, it does not look like China's coming to the table.
Yeah, hey, John, good morning. No, at this moment it doesn't. And President Trump, while he's trying to strike that optimistic tone when it comes to a potential trade deal with China, he does say that he's still waiting on Beijing's call. And now Bloomberg Economics estimates that a 100% tariff on Chinese goods would virtually halt all U.S. imports from Beijing over the medium term, let alone the now 145% levy that we're seeing. We should say that that is a 125% tariff stacked on top of that 20% tariff that went in against Beijing back in February over those alleged concerns when it comes to fentanyl trafficking. Now, of course, all this contributing to the concern in the markets, as you know, with President Trump reiterating yesterday that there is going to be some, quote, transition costs for long-term gain. And Treasury Secretary Scott Bessent really downplaying investors' concerns, calling yesterday's market moves not unusual and vowing that there will be certainty in the next 90 days. But, of course, the issue is that there is so much uncertainty, particularly when it comes to the future of a trade deal with China. And when it comes to the other more than 75 countries that this White House says have reached out to try to strike a deal, NEC Director Kevin Hassett yesterday actually narrowed that number in scope. He said that the White House is approaching about 20 countries that have put forward deals that he characterized as sensible. And John, I actually had the chance to catch up with the NEC director yesterday at the White House, and while officials keep pointing us to those non-tariff barriers that we often hear about, like regulations and taxes, he also told me that military matters, like U.S. defense spending abroad, could make their way into the deals that we end up seeing. And John, as you know, this White House is now really trying to push that this is about economic security, but also national security as well, which is often related to our competition with China.
Tyler, thank you. Tyler Kendall down in Washington. More from Tyler later on this morning. That's the relationship between the United States and the Chinese. Let's talk about the Europeans. Stuck somewhere between a rock and a hard place right now. Bloomberg's Ollie Crook joins us with a special guest. Good morning, Ollie.
That's right, Jonathan. I'm here in Warsaw at the sidelines of the finance ministers meeting where European finance ministers are really trying to devise a response to the Trump administration. I'm very pleased to be joined by a man at the center of that conversation, Jurek Kukies. He is Germany's finance minister. Thank you so much, Minister, for speaking to us today. We heard from Ursula von der Leyen today. We still know that the Europeans want a negotiated outcome. She's calling for a completely balanced deal between the EU and the United States. What does a completely balanced deal look like?
Well, I think the European Commission made it very clear that the best solution is to reduce all tariffs to zero. And I think that is what complete balance means. If we go 0-0, then we no longer have to debate around asymmetries of who's levying the higher tariffs.
And as you know, the Trump administration is really focused on this concept of non-tariff barriers, very abstract concept, could target VAT, food standard regulations, tech regulation, those sorts of things. Is it appropriate for that to be on the table in these discussions? Is it appropriate for D.C. to legislate Europe from there?
Well, certainly the allegation that the European VAT system in any way, shape, or form distorts trade is wrong. That we will categorically push back on, because everyone pays the same VAT. That's the difference between a VAT and a tariff. So European companies pay VAT, US company pays a VAT, just like everyone in the United States pays a sales tax. So that is certainly something that we do not accept. What I do think offers room for negotiation, for example, the automotive industry has proposed standardization and homologization, i.e. that if you have license to operate a car in the United States, whether it's built by an American company or a European company or a Japanese company, it also has the right to operate in the European Union and vice versa. So if we build a car in Europe, it has a license there, it can drive in the United States, and that would increase the economies of scale for both of our automotive industries and be mutually beneficial. So those things are absolutely, from our view, possible and doable and should be debated.
And on the question of possible retaliation, it seems that the markets are pushing Trump towards a sort of softer stance. That, of course, could change. What do you see as the greatest points of leverage that Europeans have in order to retaliate against the United States?
Well, the Europeans have a market of 450 consumers of goods and services. I think we have to balance the debate, because while, yes, the European Union has a trade surplus on goods, the United States has a trade surplus on services. And net, the the overshoot of one over the other is only about 3% of aggregate trade. So in that sense, we have to discuss both the goods side and the services side together.
So specifically, what measures are you looking at in terms of targeting services?
Well, I mean, the Commission proposal for the steel and aluminum sector, I think, was very well balanced and took into account the products where we can substitute easily. And if there are tariffs by products from other regions of the world, but the Commission has suspended those for now to leave room for negotiations. So for now, we have to worry less about retaliation and more about what a good trade deal could look like.
And within the markets, we've seen a flight from U.S. haven assets from U.S. Treasuries. You sort of preside over the other great haven, the Bund. Do you think that the Bund could replace the U.S. Treasury, or to a certain measure?
Well, I think the European Union now has a chance, and the Eurozone has a chance, to give stronger weight to the euro in global trade. For that, we would need an initiative from Europe to reach out to other regions of the world to speed up the conclusion of free trade agreements. For example, Mercosur is on the table. It's already signed. There's far-reaching negotiations already with Indonesia, with India, with Malaysia, with many regions of the world where there are negotiations. Those should be accelerated. We should start by lowering tariffs and then get into proper free trade agreements. And that would strengthen the role of the euro.
And on that point, we saw Pedro Sanchez speaking today in Beijing alongside Xi Jinping. Does all of this activity from the United States push Europe closer to China?
No, I don't think that has, I mean, we've been discussing the relationship and the strategy with respect to China for a long time. The fact is, the United States has just replaced China as Germany's big trade partner. Germany is now exporting more goods and services to the country we're in, namely Poland, than to China. So in that sense, the diversification of trade has already been going on for a while, and it's likely to continue because we are seeing that due to the Chinese strategy of China 2025, dual circulation, etc., it's getting harder and harder for German companies to follow the classic model of building in Germany and exporting to China.
And a final question on that. The euro opened yesterday at 109. We broke through 114 today. There's been a huge surging in the euro. That is going to make it also very difficult to prevent goods from China to come into the European market. What are you doing to prevent that? Do you need to erect more trade barriers against China?
Well, first of all, on the euro, of course, we're concerned about volatility in markets. So far, the markets are behaving in an orderly fashion. We've first seen a strengthening of the dollar relative to the euro over the past months, and now the euro is recovering and even going into positive territory relative to, for example, the time of the U.S. election. So in that sense, we're watching markets carefully, but we don't see anything disorderly or the markets are functioning very well. On the discussion on China, of course, you can take the example of the automotive sector, the battery electric vehicles, where the European Union has made decisions and is now negotiating with China. And one of the elements on the table, of course, is level playing field, and Europe rightly insists on a level playing field, and that has to be satisfied, and we cannot accept unlevel playing fields.
Well, Jürgen Kukis, thank you so much. That was the finance minister of Germany here speaking on the sidelines of the finance ministers meeting here in Warsaw. John, I'll send it back to you.
Ollie, great work. Thank you, buddy. As always, Ollie Crook there with the German finance minister, using our favorite line, when in doubt, we're watching markets carefully. Up next on the program, Gerard Cassidy of RBC looking ahead to bank earnings. BlackRock just coming out, flows disappointing. Larry Fink comparing this period to periods like the financial crisis, COVID, and surging inflation back in 2022. From New York City, this is Bloomberg.
in case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This week is not over yet. I know it doesn't feel like it, but on the week so far, we're higher by 3.8% on the S&P 500 through Thursday's close, on course for the biggest weekly gain of 2025. Certainly does not feel like it. Futures up again this morning by 0.9%. On the Nasdaq 100 up by 1 percentage point. 3 hours away from that opening bell. Let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. I'm starting with that outperformance in tech because we are seeing Google shares in the pre-market up 1.4%. It does almost feel like a project in futility to try to assign the exact reason that Alphabet is up, but I will point out the Mag 7 falling 5% yesterday, so there could just be some element of rebound when this thing starts to trade like a penny stock. But I would also point out that the information reporting this morning that Google is laying off hundreds of employees in its Android and Pixel units. Big changes maybe to come for big tech. Dan Ives writing that the tariffs rip out the heart and lungs of the supply chain for these companies, and AI and cloud spending may drop 10 to 15%. We're also seeing on the move this morning, BlackRock reporting its earnings. It actually was lower. It's now moved to unchanged this morning, missing on flows. We did also see them miss on profit too. And of course, the quarter doesn't even capture the onset of tariffs. We heard from Larry Fink saying that uncertainty and anxiety is gripping client conversations, lightening the period to the great financial crisis, COVID, and the inflation pickup of 2022. Finally, just want to show you a price check on JP Morgan just to see where we stand ahead of the earnings. Those shares are moving higher, 1.3%. So in about 30 minutes time, we'll get JP Morgan alongside Wells Fargo. And then 30 minutes after that, Morgan Stanley. John.
Danny, looking forward to it. Thank you. Danny Berger there. On some of the things to watch this morning, on our radar this morning, China raising tariffs on all U.S. goods to 125% and saying it plans to ignore any further tariff hikes announced by Trump. The move coming after the White House clarified that levies on Chinese goods, Lisa, are now at 145%.
That's higher than on Liberation Day, and the fact that it took them a while to even come up with what the calculation was gives you a sense of just how much uncertainty there is. Right now, there is a shift in the dynamic. It seems very difficult to see China calling that phone that Trump is waiting by to get that call from Xi Jinping. Now the question is, how feasible is some sort of decoupling, and whether China's taking other tactics like selling treasuries?
And they're throwing gasoline on the fire when it comes to the rhetoric, let alone you think Xi Jinping's going to pick up the phone. They said it's become a joke when it comes to these tariff rates, which is why they said even if the United States hits back, we're probably going to leave it here. But Trump has been very gracious about Xi Jinping himself and saying if he does call, I'm going to welcome that call. The issue is, what is the off-ramp right now for both Washington and Beijing? There doesn't seem to be one.
Still waiting for the European move as well. We had the German perspective about 5 minutes ago. This is the Spanish perspective. Spain's Prime Minister repeating calls for the EU to deepen ties with China, following a meeting with Chinese President Xi Jinping. This coming after Treasury Secretary Scott Bessent warned the EU against pivoting towards China and away from the United States.
Scott Bessent actually has some sharp words saying that would be cutting your own throat. And what the Treasury Secretary has talked about is actually doing deals with all the trading partners and then collectively approach China and try to go after some of the things China does, like subsidies, like dumping on foreign markets, like pushing down their currency, making it much easier to trade, things that they're doing that, frankly, no other trading partners are doing, which is why Donald Trump has a huge problem when it comes to Xi Jinping. But when it comes to Spain, this is what makes the European Union so difficult. Pedro Sanchez, this is his third visit, I believe, in 2 years to Beijing. And on this visit, he's saying that the U.S. levies are unjustified, unjust, and harmful for everyone. I wonder what his conversations are looking like in Beijing about their unjustifiable trade.
I'd love to be on a fly on the wall, just to see if that is being pushed by the Spanish at all. You're seeing a rapid series of diplomatic visits from a range of countries. Mexico's having its say. A Mexican trade official saying the country wants a greater proportion of each auto built there to qualify for U.S. origin status. The move would temper the impact of Trump's tariffs on one of Mexico's most important exports.
So they're looking for exemptions. They're looking for carve-outs. They're trying to figure out how to get their iron in the fire here, which just highlights how difficult these negotiations are going to be in a country-by-country basis. It is complicated by the fact that right now the administration, I believe, is looking at suing Mexico for not providing and stealing water from Texas, according to the rhetoric coming out of there. So those tensions aren't over. What this highlights to me is that in these 90 days, there is a lot of work to do, and it's hard to see how it all can get done smoothly, easily, with concrete deals.
Let's see how smooth the next 15 minutes are. Equity futures positive by 0.9% in just a moment. Numbers from JP Morgan and Wells Fargo as we await first quarter results from the big banks on Wall Street. Joining us now, Gerard Cassidy of RBC. Gerard, welcome to the program, sir. What an unusual reporting season for the banks on Wall Street. What are you expecting to hear in a few moments' time?
John, that was an understatement about how unusual this reporting season will be, because it's a tale of two cities. The actual quarterly numbers, just very briefly looked at Bank of New York. They just hit the tape. Looks like they beat expectations on the bottom line. But you bring up a good point, because what we're likely to see is the first quarter numbers, especially for January and February, were actually pretty good for the banking industry. It was really March, and then, of course, here in April has been very disruptive. So what we're expecting is that we're going to see decent, good numbers in the first quarter for most of the banking services, particularly trading for the big investment banks. Investment banking revenues are expected to be down year over year, but more importantly, it's what they're going to talk about in the future, John. That's, what do we expect for the rest of the year? And that's going to be very interesting.
Yeah, Bank of New York, since you just mentioned them, they did see a real boon from what we saw with net interest income because of their reinvestment in higher income-producing instruments. This doesn't seem like a main story for the rest of the banks. The main story is going to be about loan loss provisions. It's going to be around mergers and acquisitions and how much that continues. And it's going to be around just how much they are expecting and preparing for a recession. Gerard, are we expecting to hear anything concretely that gives us a sense of just how much some of these banks are preparing for that?
It's going to be interesting, because the net interest income number that you just referred to for Bank of New York, that is very favorable for all the banks, particularly the regional banks, since the majority of their revenue, of course, comes from the net interest income line, which is what they generate from their earning asset yields less their funding costs. And that's the key. Remember, the so-called back book, those are the loans and the securities purchased 3, 4, or 5 years ago. They're being reinvested at higher yields, and their funding costs are coming down. So that bodes well. But you touched on something important, which is the loan loss provision or credit. Under the current accounting standards, as the economy, or the expectation that the economy is going to deteriorate, you've got to build up your reserves. And we expect that to be the case in this quarter for all the banks. But there's no credit deterioration that they're seeing. It's an accounting procedure that they have to start building up those reserves. So those will be two key numbers for all the banks, even the large money center banks.
Let's bring Sonali Basak into the conversation as well. Sonali, welcome to the program. As always, a big moment for the big banks, but it feels bigger this time. We heard from Jamie Dimon already so far this week, and he appeared to play a key role in that 90-day pause that we eventually heard from President Trump.
Yeah, when there's a crisis, of course, Jamie Dimon is a front and center. And you remember, when things get tough, JP Morgan has benefited in large ways. I'm reading our own Top Live blog now in preparation for these earnings, just, that drumbeat. And you remember, during COVID and during the banking crisis, JP Morgan was able to make out very well, take on teams, buy a bank. And so in this instance, what's interesting to me is the estimates right now for trading revenue alone, speaking to Gerard's point about how well they're supposed to do, is supposed to be almost $2 billion more than the prior quarter. That's how much more they're supposed supposed to gain. Now, even in the last 4 quarters, John, you've seen their average loans rise at a smaller pace. So in addition to loan losses, I'm watching how much they're actually lending in this environment. We also get University of Michigan sentiment later today. Are consumers willing to take on loans? We know businesses more recently have not been able to.
Shonali Basak on the latest. Shonali, we'll cross over to you in just a moment when those numbers drop in the next few minutes. I want to come back to you, Gerard, and just get your thoughts on Jamie Dimon and the CEOs on Wall Street more broadly. Are you expecting an unvarnished view of what they think is going on right now, or do you expect them to take a more diplomatic approach, worried about how that might turn out with the administration in weeks and months to come?
I think the way Jamie Dimon presents his thinking and what's going on is very realistic and straightforward. You could call it unvarnished, but I think he's very good at telling everyone the way it is, the way he and what his expectations are. So he's not going to sugarcoat it or candy coat it. Nor will I don't think any of the other CEOs. That they'll be very practical and straightforward about what they're seeing, what their business customers are telling them about their borrowing needs, and what the opportunity is for loan growth. That's going to be another big topic. Is we expect the loan growth numbers to be much slower than what we all thought in January.
It's the real-time data we need right now. Gerard Cassidy of RBC, stay close in the pre-market. JP Morgan higher by something like 1%, 2%. Lisa, we can't depend on economic data at the moment. People say it's dated. This is a real-time look at the U.S. economy coming from the bank CEOs over the next hour that I think is so important in a moment like this.
How much are they preparing for some sort of recession by building reserves, even without any visible deterioration in credit loan losses? How much are they discounting the resurrection of all of those mergers and acquisitions that we were supposed to get? Are those off the table now? And just how much are they preparing for bad times ahead, especially given that the source of volatility is in the safe asset, the Treasury market?
Earnings season kicking off on Wall Street. Equity futures up by 0.8% with an update on stories elsewhere. With your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. Bank of New York Mellon saw a 6% increase in the first quarter revenue and a 21% profit jump. But the results don't factor in recent market turmoil caused by President Trump's tariff rollout. The bank warned of an uncertain outlook ahead as it undergoes a continued cost-cutting overhaul. Elsewhere, Mexico is vying to protect its auto shipments to the U.S. in the wake of President Trump's 25% tariffs on cars. A trade official says that the country is looking for ways to move parts of the production process to the U.S. to increase the deduction. He said Mexico's goal is to have one of the lowest tariff rates of any country in the market. In Europe, leaders are reportedly planning a trip to Beijing for a summit with President Xi in late July. The South China Morning Post says that the trip indicates a serious effort from the EU to re-engage with Beijing. The U.S. and China are also starting talks to end the EU's duties on EVs from China amid tensions with the U.S. over tariffs. And that's your brief, John.
Hey, Danny, thank you. Danny Berger there with the latest. Up next on the program, earnings season kicks off on Wall Street.
Investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, that's what the market sort of needs to hear.
In just a moment on this program, numbers from JP Morgan, reaction from Gerard Cassidy of RBC, and Shonali Basak will break it down. From New York, this is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. Can I say that in Bloomberg?
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Ready? Go.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Just seconds away from numbers from JP Morgan and Wells Fargo. Can the earnings from the big banks improve the mood on Wall Street? Equity futures at the moment positive by 0.7% on the S&P. Under surveillance this morning, earnings season kicks off on Wall Street.
The whole capital markets renaissance is just not quite happening. But trading, as you can imagine, given all this volatility, trading could be lights out for this quarter. The reaction of banks really told me that investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, that's what the market sort of needs to hear.
Numbers from Wells Fargo just crossing. To break it down, here's Shonali Basak. Hey, Shonali.
John, we're taking a look at Wells Fargo coming through, and of course, in addition to looking at the loan loss provisions, we are looking to see how their return on equity is. Their net interest income is holding in at $11.5 billion. Now, that is less than expected. That sets the tone, doesn't it, for the rest of the bank earnings season, particularly for the many, many regionals that are going to look at potential lending income under pressure. You are not seeing shares reacting, but remember, Wells Fargo did fall more than, for example, JP Morgan has this year. JP Morgan only seeing a decline of roughly 5% on the year. We are, however, also seeing JP Morgan numbers coming in. We'll also give you the guidance. We are watching guidance closely from these banks. Wells Fargo still sees full year net interest income growth to 1% to 3% higher. So that is a very promising sign coming from a bank where people have been somewhat concerned here about the trajectory of consumer lending.
So, Shonali, it's a miss on net interest income, but as you say, the guidance is still okay. It's difficult to guide in this moment. I would say it's difficult for analysts to even come up with an estimate for the first quarter, considering the warnings we had from elsewhere. As you say, Shonali, JP Morgan numbers out just as well. What do you see?
A few things. Provision for credit losses at $3.3 billion. We'll dig into that in just a moment here because that is a smidge higher than what we had been seeing analysts estimate. However, you are seeing the stock really shrug this off. You are seeing fixed income sales and trading revenue come in just a smidge below estimates here. But remember, this is where the trading estimates were estimated to be very high. You're seeing a net reserve build of almost $1 billion, around $973 million. Equities trading did come in above estimates, John. I think this is where things get really interesting here because remember, hedge funds did come into this year with near record high leverage, but a bank like JP Morgan, I would say for Morgan Stanley as well, captures the retail traders as well. JP Morgan in the last quarter coming out with even new ETFs to capture the volatility and maybe even a potential decline. So you could see JP Morgan in a scenario where they win if you do, they win if you don't. They can win in a lot of scenarios here. And certainly the stock up 2.5% pre-market. That's erasing almost half the losses for the year so far.
Shanali, can I just come back to you with another number and get your thoughts on this? The net reserve build of $973 million. How important is that this morning?
You know, when I'm sitting here, you could have expected it to be worse. You can expect that they would be building this, right? You saw Jamie Dimon's recession calls be more loud than normal. For him to come out on a television interview days before earnings, how rare is that, John? And you would expect more reserve build to be cautious, but that's what investors would want to see right now. Caution from the banks in the face of this uncertainty.
Well, this economy has bigger concerns than just bank earnings in the first quarter, that's for sure. Shanali, stay close. Let's go through these numbers. So the first quarter for Wells Fargo, net interest income coming in just below expectations. As Shanali pointed out, they still see growth for net interest income for the year ahead. That's positive, given the moment we're in at the moment. If you go to JP Morgan, this is what we've got for both fixed sales and trading revenue versus, say, equity. So equity sales and trading revenue coming in at $3.81 billion. The estimate was 3.18. So that's a big upside surprise. A little downside surprise on fixed sales and trading revenue. Lisa, we often talk about volatility, the good kind and a bad kind. What did we get in the first quarter?
It seems like the volatility in stock trading was the good kind, the volatility in bond trading was the bad kind. And I guess if you talk about the whipsaws that we're seeing, this still is backward looking, so we shall see. Going forward, I think the most interesting aspects are some of the commentary that we're getting from Jamie Dimon, JP Morgan, when it comes to building reserves. It isn't as big as I would have expected, to be honest. You asked Shanali about the almost $1 billion of loan loss reserves. The commentary, though, suggests a greater degree of caution, with Jamie Dimon saying it's prudent to maintain excess capital and ample liquidity, echoing what he said in the letter, and saying that that reserve build was largely driven by changes in the macro outlook, not necessarily by what they're seeing in terms of deterioration on the underlying loans.
The stock is up this morning. JP Morgan higher by 2.6%. Jared Cassidy of RBC is back with us. Jared, you've had a few minutes to go over them. What's your reaction?
John, the numbers are good in both cases, Wells Fargo and JP Morgan. What was very encouraging was Wells Fargo did not lower their net interest income guidance for the full year. The 1% to 3% growth that you guys just reported is what they said in the fourth quarter results. Also, what's interesting is the provision for loan losses at Wells Fargo was not that high relative to the prior quarter. It was below our expectations. Now, on the other hand, as you just pointed out, John, the provision from JP Morgan, over $3 billion, that was higher than expected. But what the numbers are showing us is that as these banks build up reserves, they're still beating bottom line numbers. And so that goes to show us the strength of these companies' revenues and their balance sheets. And as Jamie Dimon pointed out in the commentary, this is reserve building. It's not because there's credit deterioration today, as we were chatting a moment ago. This is for the accounting for reserves for potential future losses. And when the economy is weaker or expected to be weaker than expected earlier in the year, this is what they need to do.
Gerard, we're looking at a yield curve that's steepest going back to 2022. Yes, it's for all the wrong reasons and it's spooking the markets, but is this a positive thing for the banks that encourages your view, at least on their net interest income?
Very good point. When you think back, it's 20 years that we've seen the Fed funds rate above 3% with a positive slope to the curve. So even if the Fed cuts 2 or 3 times this year, if the 10-year stays over 4%, that type of interest rate environment with the positive slope is very positive for net interest income for all the banks.
How often have you seen this, Gerard, where the rhetoric is incredibly negative, but the actual numbers are not? Both with respect to the credit build, the loan loss build, which is, yes, almost $1 billion for JP Morgan, but it could have been worse with Wells Fargo coming in below. How much does this resonate with another period versus really unique, where there really is a black box ahead of us?
Yeah. We're in uncharted territory because the new relatively new accounting came in on January of 2020. Now, granted, we had the pandemic and the banks had to rush to build reserves only to reverse them out in 21 and 2022 since the economy snapped back so quickly due to the government stimulus and the Federal Reserve actions during the pandemic. So this is the first real test of the new accounting, building up reserves. The idea was to get out and ahead of any credit issues. It's more pro-cyclical. The banks have been very critical of this reserve building methodology because it may force banks to pull back on lending. But right now, this is the first time we're really going through it. And as so far, the banks can handle the buildup in reserves due to the strength of the revenues and the interest rate environment they're working in.
Hey, Jared, hang tight. Just took another leg higher in the stock. JP Morgan up by 3.7%. Check out this headline. Sonali Basak has more. Hey, Sonali.
John, some things that I'm taking a look at here, of course, is exactly how much people are still borrowing at JP Morgan. You are seeing the consumer in good enough shape that the debit and credit card sales volume are actually up 7% year over year. And so things look pretty good in the face of what has been a very challenging environment. I would also say in the face of the volatility we've seen, and remember, this was the first quarter, they do still see full year net interest income about $94.5 billion. That's higher. That's actually $500 million higher than the previous estimate. So they're still expecting to make money on loans, and you are seeing it in the credit card books at JP Morgan. Last thing I'll say, I took a look inside their supplement at their value at risk, because in these markets you take a look at how much these trading desks are getting stretched. Certainly it is higher, and it is meaningfully higher in the equities business and in the commodities business, partially as you'd expect, not yet in fixed income. My question for Jamie Dimon is how much risk is this bank willing to take on?
Sonali, thank you. Just a final word, Jared. That was the headline I was looking for. Full year net interest income about $94.5 billion. They had seen about 94. What do you make of a headline like that in a moment like this?
John, that's actually positive for JP Morgan, because you might remember when they've talked about their net interest income numbers during a period of falling short-term interest rates, that kind of lowers their net interest income, because generally their duration is on the shorter side compared to some of their other peers. And so for them to come out and give that kind of guidance with the expectation that the short end of the curve is going to come down, again, is encouraging and positive. So when you look at, you wrap it all together, the numbers are good as we expected. Nobody was expecting bad numbers on the first quarter, but the outlooks aren't as negative or threatening as maybe some people were expecting.
Jared, appreciate it. You're going to stick around, I know. We'll catch up with you when Morgan Stanley comes out. Jared Cassidy there of RBC. Elisa nailed it. The difference between the rhetoric and the actual numbers, that is a positive guide from JP Morgan.
Talking about net interest income, this goes to the upside of a positive yield curve, but all around, as much as they are preparing for possible negativity, there clearly is an eye toward not losing market share and having a very stable position heading into the next leg of turmoil. It is a different time than back in 2008, despite all the comparisons.
Stock is up by 3.7%. Up next on the program, we'll catch up with Sarah Hunt of Alpine Saxon Woods, the U.S. Energy Secretary Chris Wright, Jared Cassidy of RBC will be back with us for Morgan Stanley, and Greg Peters of PGIM, Fixed Income. From New York, the second hour of Bloomberg Surveillance. Up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. At the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The U.S. is exceptional. Still the most dynamic economy, still the biggest financial market.
The outlook has been very, very bearish on U.S. equities.
Growth is still going to be at or close to flat for this year.
Whatever your economic assumptions were, they've got to be lower today.
We are far from out of the woods here. There is a slowdown coming in the economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Believe it or not, heading towards the biggest weekly gain of the year so far in the S&P 500. What a wild week it's been. Equity futures this morning positive again by 0.6% on the S&P. On the NASDAQ 100 higher by 0.7, even with retaliation from China. It is so difficult to internalize these numbers now. China putting 125% tariffs on the US after the US put levies on China to 145. We need to focus on the banks this morning. This from JP Morgan. JP Morgan coming out with new guidance. Lisa, I think this is absolutely phenomenal. For a moment like this to come out and say, you know what, we'll raise our guide. 94.5 on net interest income. They had seen about 94.
This is a time where the rhetoric is, this is a very turbulent economy, from deregulation, trade wars, let's raise our excess capital. This could be a real game changer. And by the way, our profitability is going up. Our net interest income, as you said, $94.5 billion versus $94 billion. It goes to this ultimate question. We are in a moment of catastrophic language and rhetoric and very hot tempers and very big threats and historic moves potentially. But at the end of the day, companies are doing pretty well, and banks are in a good position to absorb this and build capital. And this is the dissonance that a lot of investors are striking against.
That stock is up by 3.3% in the pre-market. Let's get to some of that language from Jamie Dimon of JP Morgan. Anne-Marie, he says it's prudent to maintain excess capital and ample liquidity in a moment like this.
So he doesn't say Trump by name in this statement, but he's talking about Trump in this statement. The economy is facing considerable turbulence, including geopolitics, with the potential positives, though, of tax reform, deregulation, there's negatives of tariffs, trade wars, ongoing sticky inflation, high fiscal deficits, and still rather high asset prices and volatility. A long list of worries, Jonathan, from all of these banks, especially Jamie Dimon, because of what's coming out of Washington, D.C.
Let's talk about a few of the words that came out of Washington yesterday. The President of the United States, there will be a transition cost. and transition problems. Who's going to pay that price in the quarters to come?
It's a great question. This is the ultimate question. Is it going to be consumers? Which consumers? At the high end, maybe there is some capacity, but we have seen with Walmart, they're going to try to take share by absorbing those costs in their margins. This is the ultimate question. What does an adjustment period look like? What is on the other end? Because we still don't have a sense of what the goal is. Is it a full decoupling, or is it something that is a new rules of the game that is still at least playing the game?
Equity's pretty volatile this morning, as you might expect. Once again, equity futures this morning positive by 0.6%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Sachs & Woods as China imposes 125% tariffs on U.S. goods. We'll speak to the Energy Secretary, Chris Wright, on President Trump's push to drill, baby drill, and Greg Peters of PGIM Fixed Income as Treasuries start trading like risk assets. Bank earnings kicking off in the last hour. Bloomberg's Sonali Basak can break it down. Hey, Sonali.
Good morning, John. You are seeing JP Morgan shares higher after they said that they expect more net interest income this year than earlier expected. They raised their projection for 2025 by about $500 million. And you also see provisions for loan losses coming in higher, though investors clearly shaking that off because JP Morgan tends to be conservative. Of course, Jamie Dimon all week has been warning of increased uncertainty in the macroeconomic environment. You also see Wells Fargo higher as well because they kept their net interest income guide stable. As Lisa has been mentioning all morning, you do still see a steeper yield curve. And from JP Morgan's numbers, you also see an inclination from customers to borrow, particularly those debit and credit card loans still up by 7% in the first quarter, even in the face of this uncertainty.
Sonali Basak on the latest. More from Sonali later this morning, 7:30 Eastern Time. You'll hear from Morgan Stanley. This line from Jamie Dimon: we hope for the best, but prepare the firm for a wide range of possibilities and scenarios. That range of scenarios, incredibly wide. This is what Sarah Hunt of Alpine Sachs & Woods has to say. The damage has been done, both to markets and to sentiment. Goes on to say, what we do know is that the uncertainty is likely to continue. Sarah joins us now for more. Sarah, good morning.
Good morning.
How much weight can you put on the guidance from the banks this morning?
Well, I think it's interesting that they're giving guidance at all, because I expected a lot more of a, not necessarily polling guidance, but a larger uncertainty. We were going to bracket things. So I think that there is a call to strength there that says, you know what, we see what's going on. We see what's going on in the fixed income markets, and we see that this is actually going to be a decent year for us. And I think for the bigger banks, that's an easier thing to say than it is for some of the smaller banks.
Think how positive people were coming into 2025. Sentiment sky high, loan growth will improve, capital markets activity is going to be fantastic. Lisa was asking this question in the last 30 minutes or so. The capital markets activity now for the financials, delayed or derailed? Which one is it?
I'm going to say delayed. I don't think it's necessarily derailed. I think that ultimately, you know, what was interesting about the comments that you brought up earlier, Anne-Marie, was that in that long list were some of the things that are supposed to be positive, which is the deregulation and which is some of the mergers and acquisitions and stuff that we were talking about going into this. But the fact that the tariffs came so soon and the tariffs came so hot relative to what the expectations were, I think has got everybody losing sight of the fact that there may be other things. And I'm not sure any of us know exactly what that's going to be.
Is the market reacting to the hot rhetoric, or is the market reacting to market structure issues that are amplifying moves that are then causing people to, for lack of a better word, freak out?
So this is another problem where the answer is yes, because it's all the things, right? It's both they're reacting to the moves, and there have been some ongoing discussions about what's going on underneath the markets and whether there's anything going on within the structure of the Treasury basis trade, the FX markets. So I think that there's a combination of things where you get the first reaction on fundamentals, and then the second reaction comes from things that we're not necessarily able to see.
Where are we in that? I mean, is there a sense that there's something that just blew up, or there's something that's in the process of blowing up, and we're watching it and then creating a narrative around American exceptionalism around it, and then adding some talk about that, and everyone's running to the edges and just hiding? I mean, I'm trying to figure out the anatomy of what is going on after a really tumultuous couple of weeks.
I think that you are not the only one. I think all of us are trying to figure out what's been going on underneath the surface and or the size of some of these moves, how problematic that is, because so many firms have levered up more and more as we've had less volatility, and then you get volatility that is off the charts, and you have to think that there are some reactions to that, and some of those are going to be people making a lot of money, and some of them are going to be the opposite. And I don't think we have an understanding right now of which is the bigger piece of that as money also moves out of the U.S. and goes to other places, which are smaller than the U.S., so therefore the effects are magnified. So I think that there are a lot of different parts of that equation, and I'm not sure that we're able to simultaneously solve it right now.
The Treasury Secretary said yesterday they're going to go through the queue when it comes to these deals they're making with other countries, and then there's going to be a period of, quote, great certainty after these 90 days. Is that what you expect, 90 days, and you get some certainty in the market?
I would love to see great certainty in 90 days. I'm not sure that you're going to get great certainty because I think that as we go through all of these things, there's going to be continuous changes. So I think that if you take some of the uncertainty off the table, which we haven't yet at all, and I think that there was some expectation that once the announcements were made, that was going to be a catalyst in and of itself from an uncertainty standpoint, and all it's done is ratchet that up. So I think that there is going to be some, as you start to get deals through the pipeline and people start to understand what they are, I think that will help calm things down. But right now, we're still in that phase where that hasn't happened yet, and I think that max uncertainty that we all keep hoping to get behind just continues on a daily basis.
The forward multiple on the S&P doesn't scream recession right now. Cameron Dawson made that point in the last hour. From your perspective, given the price move we've already seen, do you think we have the capacity to absorb bad news now, going into the next several months where we might see some pretty big downside surprises on data?
Well, I think that we came into this year with the market at an even elevated multiple than it was right now. So is it back to a place where you can feel very comfortable with it? No, which is why I think that you've got risk to the upside and risk to the downside, because you get really good news and this market wants to take off. You get really bad news and we can say, you know, the multiple's still expensive and it can still come down a little bit. I think that what we're looking for is a very choppy year, unfortunately, and some hope that as you get through some of these issues in terms of understanding what's going to happen, that people can start making decisions and that delayed economic activity doesn't accelerate too much.
So in the meantime, we just want somewhere to hide. Some people do anyway, some people more aggressive than that. But if you want a tin hat and a rock to hide under right now, it's not the Treasury market. What is it?
It's not the Treasury market. It's some of the areas that have done fairly well in general recessions, those things like consumer staples, they got really, really cheap at the end of last year, and everybody was looking for more exciting things and more growth. And then you look at those multiples, you go, you know what, that's not so scary. Some of the defense stocks have gotten killed also, and so I think that there's some opportunity there. There are some places, even something like Walmart, look at the big banks. There are places where they can absorb it. I think the harder thing is going to be for smaller and mid-cap stocks because the uncertainty is very high right now, and I think for them it's much more difficult.
I want to sit on one point that you said and make this full circle. The big banks, coming into this year, a lot of people were really excited about them because of the growth in the economy that they were expecting, as well as deregulation wave. That's something that we heard from Jamie Dimon, that the deregulation is going to be a real positive. We also are seeing that steeper yield curve that could also benefit these banks. In some ways, are the banks a haven in good times and bad, given how much they've built capital and what a different position they're in now than pre-pandemic?
I think that it's a much different situation for them now. But I also think if you look back when all the technology stocks are outperforming, the banks are underperforming. So in good times, they tend to lag a little bit. And in bad times, I think people go, oh my goodness, there's a great business model. And we're all looking at cash flows. We're all looking at balance sheets again. All of those things become of utmost importance when you have this much volatility.
Can we finish on tech? What becomes of Apple if we don't get an exemption for that name? What happens to some of these companies?
I don't necessarily want to speculate on what happens to Apple if it doesn't get an exemption. I think that...
Is it that bad that you couldn't possibly even speculate?
Well, I mean, you can speculate and you can say, well, if 90% of their phones are coming from here, then we lose X amount. I think the problem is it is such, I mean, this goes back to those discussions in 2018 and 2019 that the tech stocks are actually staples of themselves, because are you going to live without an iPhone? And how many people are going to say, okay, now I'll just go back to the method of financing it that the phone companies used to do, and I won't buy it outright, so that $2,000 doesn't become as scary as $1,200. They're expensive things to start with, but I think that the ingrainedness of that technology into our lives is difficult to separate. So I don't know that for that reason it's as bad as it would be, because it's not a lot of speculative buyers of iPhones.
Sarah Hunt, appreciate it. Of Alpine Saxon Woods. We did see some speculative buying of iPhones earlier this week, didn't we? Weren't they flooding the stores?
Yeah, well, and honestly, I think about that. My kids buy phones. It feels like speculative purchases. But also, India, the idea that they loaded up iPhones from India, put them in a plane, forget gold, iPhones are the new gold, and ship them over here gives you a sense of how people are preparing.
People have been flooding these Apple stores, stockpiling, not just iPhones, AirPods, iPads, everything, get ahead of birthdays, holidays, because the price might be going up.
Buying iPhones off the back of a truck in a few months' time.
100%.
Just bring it back to
Bananas,
BlackBerry.
iPhone.
I just want a BlackBerry.
These are first world problems. Equity futures on the S&P 500 up by 0.75%. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John, let's just recap some of those bank earnings. JP Morgan shares in the pre-market up nearly 3%. Their stock trader taking in a record haul in the first quarter and raising its guidance on net interest income, but it did add more than 3 times of what was expected for its lost reserves. CEO Jamie Dimon saying it would be, quote, prudent to maintain excess capital and ample liquidity, noting that economic turbulence was there amid trade wars. Now for Wells Fargo, it did miss on net interest income. Shares are higher, though, 2.33%. Loan demand did remain soft. CEO Charlie Scharf said that the bank is preparing for a slower economic environment amid continued uncertainty and volatility, and that a timely resolution to the White House's trade action would be good for business, consumers, and the market. Elsewhere, Defense Secretary Pete Hegseth plans to cut $5 billion in contracts as part of his partnership with Elon Musk's Doge efforts. The cut will target services, including consulting, impacting companies like Accenture, Booz Allen Hamilton, and Deloitte. Hegseth did not mention any termination costs, though, that might be associated with canceling those contracts. And that's your brief, John.
Hey, Danny, thank you. More from Danny later this hour. Numbers from Morgan Stanley dropping at 7:30 Eastern Time, so about 17 minutes away. Up next on the program, Beijing retaliates.
We'll see what happens with China. We would love to be able to work a deal. I have great respect for President Xi, and I think that we'll end up working out something that's very good for both countries.
In just a moment, we need to talk about commodities. Crude down since April 2nd by 16%. Up next, the Energy Secretary, Chris Wright from New York. Good morning.
The Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
You've got 2 options in a moment like this one. You can listen to what the banks are telling you, or just read the numbers. Read the numbers. The guide's pretty decent from JP Morgan this morning. Maybe it's difficult to guide in a moment like this one, but the guide is pretty good for the rest of this year. Offers some support to the equity market, up by 0.4% on the S&P. On the NASDAQ, up by 0.4% also. Under surveillance this morning, Beijing retaliates.
We'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. We're resetting the table. And I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a true sense, he's been a friend of mine for a long period of time. And I think that we'll end up working out something that's very good for both countries.
So here's the latest this morning. China raising tariffs to 125% on all U.S. goods after the White House clarified China faces a 145% tariff rate on exports to the United States. I'm pleased to say that joining us now is the 17th United States Secretary of Energy, self-described energy nerd turned entrepreneur, now dedicating his time to public services. Mr. Secretary Chris Wright, thank you very much for joining Bloomberg Surveillance this morning. We appreciate your time. We just wanted an initial reaction from you to the tariffs we heard retaliated by China overnight. What's your reaction this morning, sir?
Oh, I think you see we're right in the midst of a negotiation. This is home territory for President Trump, both in his business career and his first term as president. You know, he reads the marketplace, he engages with people, he uses leverage, and we're going to get to a great result. We're seeing the midst of it right now, but I'm quite optimistic about where we're going.
Well, the United States has already slashed its forecast for global oil demand. If we continue on this path of a trade war, do you expect demand to continue to decelerate?
Oh, their prediction of the demise of demand growth for oil is older than I am. So, look, there's cyclical factors on economic growth that do impact that. The long-term growth rate of oil, a little more than 1 million barrels of oil per day, per year, has been going on for decades. I don't see any big change in that in the foreseeable future. You see a marketplace right now that is worried about economic growth, and I think you're seeing some softening in oil prices from that. But I think that fear is misplaced. I think we're going to end out in a better economic situation than we went into this Trump term, I think by a long shot. Look, two things are driving tariff policy for President Trump. One is we've been very welcoming to exports from other nations. We want other nations to be just as welcoming of U.S. exports so we can grow our exports more in line with our imports. And President Trump wants to see America reindustrialized, investment, jobs, and heavy industry back in our country. Both those are going to be wonderful for the United States.
Well, it's not just a softening of oil prices. Mr. Secretary, I'm sure you've seen that since Trump's inauguration, prices are down more than $10. At what level do you think you can see drill, baby drill, as the president likes to call it, when it comes to shale producers? Because what we're hearing is that they cannot do this if prices fall below $50 a barrel.
Yeah, look, investment decisions of oil and gas companies in the U.S. and abroad are based on a little bit of multi-year view of oil and gas prices. They're not moved based on the spot price of oil today or oil last week or oil next week. So these are longer-term decisions that are being made. We saw oil and gas prices move down immediately after President Trump was elected. And that was the market seeing, oh yes, all the nonsense that's tried to kill the oil and gas industry, promised it'll be over soon, stop giving permits on federal lands. All that stuff is going away. And so there's much more of a green light on production. So if you put more supply into a marketplace, you're going to get lower prices. Now we're seeing, as I said, that sort of extra fear of world economic growth in the next few months over the tariff dialogue. That's real fear, but I think the marketplace may be discounting the wrong answer here. We're going to see very, very positive economic growth in the next few years.
But is it still realistic to be talking about adding, the United States adding another 3 million barrels of production at these prices?
Well, I think you're referring to Scott Bessent's plan there, and his 3 million was 3 million barrels of oil equivalent. Most of that growth will come from natural gas. And of course, the domestic demand for natural gas with the growth of AI, resourcing manufacturing, and our surging exports, boy, we will grow oil equivalent production by at least that much during President's term. But we will also grow oil production and other natural gas liquid production in the United States as well. So absolutely. Are we going to see strong growth in American energy production? 100%.
Mr. Secretary, you've been on a tour in the Middle East for about 2 weeks, and it's our understanding that before Saudi Arabia decided to add even more barrels to the market, there was a conversation, a dialogue between the Trump administration and the kingdom. Can you give us a sense of what that dialogue looked like? Is the United States supportive of OPEC Plus adding more barrels to this market?
Yeah, we don't directly coordinate on oil production policies or whatever. That's certainly in OPEC's purview. But I don't think anyone in the world misunderstands President Trump's desire to see more energy produced, therefore lower prices and more economic activity. Absolutely, that's President Trump's agenda. Look, his agenda can be summarized as prosperity at home and peace abroad. Lower oil prices help both of those. And the peace abroad that's of most concern right now in the region where I am in the Middle East is Iran. During the Biden administration, oil prices were higher. There was sort of an appeasement attitude and no strong enforcement of sanctions, enormous funding to Hamas, to Hezbollah, to the Houthis, and a rapid advancement of their nuclear program. President Trump's agenda is exactly the opposite of that. It's peace through strength, but we simply cannot and will not accept a nuclear-armed Iran.
Well, when it comes to Iran, we saw even more sanctions on the regime yesterday. When it comes to these oil sanctions, the president has said he wants to go back to maximum pressure. Is that part of the conversation you're having with Gulf allies on this tour, that they'd be willing to step in if some of those Iranian barrels come off the market?
Well, fortunately, just from the United States production itself and the size of the global oil market today, absolutely we can tolerate squeezing out Iranian exports. And of course, do all the Gulf neighbors want the same thing we want? Yes. Do they fear a nuclear-armed Iran? Absolutely. Do they think now is the time to turn the screws and end Iran's nuclear weapons program? Absolutely. But yeah, can the world tolerate that? Absolutely. 10 years ago, 20 years ago, could this have happened? No. But today we both have large American oil production, better relations with our neighbors, and a strong, resolute leader. In 40 years of trouble, 45 years of trouble from Iran, we've never had a better chance to reduce Iranian power, reduce Iranian tyranny in the Middle East, and we don't want to miss that opportunity.
Mr. Secretary, the president has said a lot, even recently to me on Air Force One. He likes that oil prices are coming down. Do you and the president have a price in mind?
No, I think my whole life I've avoided predicting prices or dictating prices. You know, we have a wonderful free market economy. That's what makes the world wealthier. That's what allows consumers to continually re-express choices in every direction. So no, there's no formula for a good oil price. There's just a broader belief that lower cost diesel, lower cost gasoline, lower cost home heating, lower cost electricity, all of those are good for American consumers and good for businesses. That's President Trump's energy agenda, and I'm here to implement it.
Mr. Secretary, appreciate your time this morning, this evening where you are. Thank you very much for being with Bloomberg TV. The Energy Secretary there, Chris Wray. The key headlines from that particular conversation. So the first real cabinet official to come out and respond to the tariffs from China overnight, calling it a negotiation. This is what we heard about demand. Lisa, concerns over oil demand are misplaced.
Yeah, that basically this is not going to be a global recession. He didn't answer the question about what this means for drill baby drill and what this means for shale producers, because ultimately, given how much the U.S. produces, are low oil prices a good thing or a bad thing for the United States?
It's hard to understand from this administration how low they want to see oil go, because you can't drill baby drill if it's closer to $50 a barrel. At the same time, they want to see lower oil prices because they think this will feed into a lower inflation number and an ability maybe for the Fed to cut rates.
Crude just about 60 this morning. Brent crude and WTI down double digits since April 2nd. We are lower by about 0.1% so far this morning. Up next, numbers from Morgan Stanley and reaction from Jared Cassidy of RBC.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Big morning for bank earnings. Equity futures this morning positive by about 0.25%. Those gains are fading at the moment on the S&P, on the Nasdaq up by 0.2%, with 2 hours until the opening bell. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. The banking stocks are still flying high this morning. Earlier, hearing from JP Morgan, a big beat on trading, a record quarter, alongside an increase in net interest income. We also just heard from Morgan Stanley, a beat. Shanali will break that down in just a moment. But for now, all these shares up at least 1.33%. Now, we also have on the move this morning as well with BlackRock. This one's interesting because it's also getting an uplift with JP Morgan earnings. Originally, when BlackRock reported earnings, shares fell because their inflows missed estimates. But then you get this good quarter from JP Morgan, and there you have it. Shares up 2%, all financials rallying, even though you had Larry Fink basically saying every client conversation is fear and anxiety about what the future holds, likening this to other crises of the past. Finally, ending this with a company that has had a rough go of it as of late. Stellantis in the pre-market trade down 2.8%. Its shipments fell 9% over the past 3 months, specifically some problems in North America over holiday periods when factories weren't operating. In January, those shipments fell 20% from North America. And of course, all these figures don't yet take into account what damage they might see from the tariffs. John.
Hey, Danny, thank you. More from Danny later on at this hour. In markets, there is good volatility, there is bad volatility. If you were trading equities in the first quarter, I think it's fair to say there was good volatility. Shanali Basak has more. Hey, Shanali.
John, this report has Ted Pick written all over it. You're looking at equities trading revenue coming at more than $4 billion for Morgan Stanley. That is handily not only beating analysts' expectations, it is also beating out JP Morgan. Another critical metric, you saw Morgan Stanley beat out JP Morgan, and I don't remember how often this happens, but not very often. It is the return on tangible common equity came in at 23%. Absolutely stunning in this type of environment. You also have them missing, however, on their margins for the wealth management business. There will be questions around how both retail and institutional clients are behaving in asset management and trading. However, the Wall Street numbers, debt underwriting also beat estimates at Morgan Stanley. They had a strong beginning of the year. That's going to be another big question as the year goes on, given the capital markets freeze. Ted Pick's heart is in that capital markets business. They've been trying to win back that share in equities, and you see the banks leaning in and taking on risk to help these markets gain steam.
So, Shanali, you did a bit of compare and contrast. Do a bit more if you can, please. Look ahead to next week. We've had Morgan Stanley, we've had JP Morgan. Look ahead to Bank of America and Goldman, two similar banks versus those two. What would you expect to see next week?
If I was sitting inside of Goldman Sachs' trading desk and watching Morgan Stanley put up $4 billion, boy, I would hope that they're putting up more. This has been an insanely competitive business in recent months, John. And I've got to say, I went back years in this break through JP Morgan's results. They have not put up this type of value at risk since 2020 and 2021 for equities and commodities. So the trading desks are working very, very hard here. At the same time, for Bank of America, Lisa made this excellent point earlier about reinvesting securities. Who does that matter more for than Bank of America? And so interesting, but the bar is also high, given we did see JP Morgan raise the bar for net interest income and Wells Fargo keep that bar high.
Shanali, just before you go, we caught up with Jared Cassidy earlier. We'll speak to him again in just a moment, and we reflected on how unusual this quarter was. Given the policy volatility we've seen from Washington, D.C., I think it makes the calls all the more important with the CEOs and the C-suite over the next few hours. Which are the ones that you'll be listening for later this morning?
JP Morgan, number one, even though we've heard from Jamie Dimon a lot, there is a lot of positivity behind that cautious tone he's taking up front. Headcount rose, if you could believe it, John, at JP Morgan. And at Morgan Stanley, even though they're cutting jobs, you do see them having efficiency better than what was expected, which would mean that maybe they can hold tight for now, that it's not as bad as people are screaming about, at least at the moment.
Shanali, appreciate the update. Bloomberg Shanali Bassett breaking it down. Morgan Stanley numbers, two headlines. Wealth and equity is very important to them. Wealth management in the first quarter, net revenue 7.3 billion, the estimate 7.44. The first quarter for equities trading revenue came in at 4.13. Lisa, the estimate there, 3.42. That's a tidy upside surprise.
So the funny thing about this earnings season is we've seen that volatility for equities, at least equity trading, has been good for the big banks. As you said, this has been a profit center, and it has been bad for bonds. It is the opposite when it comes to underwriting. Fixed income underwriting beat expectations, whereas equity underwriting missed expectations from Morgan Stanley. Basically, think about it this way. A lot of volatility in stocks. Who's going to IPO right now? And this goes to the point that the advisory revenue came in a lot lower than expected. That is going to be one of the key questions for Morgan Stanley. Are those deals derailed or are those deals delayed? Because right now, this shows that trading is making a comeback at the expense, maybe, of the primary capital markets.
Perfectly framed. Let's get Jared Cassidy of RBC into the conversation to talk about that. Jared, that's been our question of the morning. Some of that activity delayed or derailed for the rest of the year. How do you come down on that question?
At this point, John, I think we can go into the camp of delayed. It's a little early to call it derailed. We're obviously only 4 months into the year. A lot is going to change over the next 8 months. So as the second quarter unfolds and we get a better understanding of the economic policies coming out of Washington, especially about the tariffs, I think that will give us a better understanding of whether this investment banking business is, derailed. Right now, we don't think it is. But it's going to be really dependent upon the stability in the markets, as Lisa pointed out, as well as what the outlook is for the economy.
There are different banks with different profiles. Morgan Stanley, I think of as being more hinged to both the banking and the advisory side of things, the investment bank, as well as wealth management. Wealth management has been a pillar. They have been trying to grow that. That missed again. How big of a liability is that potentially to its growth plans and at a moment like this, to its ability to capture some of the gains in interest?
It's going to be interesting because wealth management has had a great tailwind for the entire industry for a number of years. And now we're into these more volatile markets that, of course, weighs on the wealth management business, though there always has been the expression buy the dip. That's been, so far a bit challenging. So the wealth management numbers, Morgan Stanley has done a phenomenal job, over the last 10 years, building out their wealth management business. James Gorman passed it on to Ted Pick. They're continuing building out that growth, but it is volatile. It's not linear. And so it's really going to come down to what, the markets do and whether the wealth management retail investor comes back into the market in a big way.
How do you explain, Gerard, the fact that we're hearing some really negative rhetoric from the banks? They are increasing their loan loss provisions. We saw that again, provisions for credit losses exceeding expectations at Morgan Stanley as well. How do you square that with what we're seeing, which is booming revenues and booming expectations for profitability at these big banks?
It's an interesting question, and as we were chatting a moment ago, it's all due to this new accounting standard, CECL, as we call it, current expected credit losses, expectations, that is. And so CECL requires the banks to factor in the outlook for the economy in building those reserves. and it's been the consensus call that the policies out of Washington will slow the economy. Generally, in a slower economy, you have greater credit losses. So the current expected credit losses against CECL require the banks to build up these reserves, even though they're not seeing any evidence of credit losses, to your point. So it's an interesting dynamic that this is the first time we're really seeing it play out, not excluding the pandemic period. So we'll see how the banks handle it. But what it shows us is the banks are well capitalized. They're buying back